Welcome to my multiple hours complete free option trading course for beginners. Yes, it's a couple hours, but this is going to be totally worth it because I noticed that nothing on YouTube right now goes in detail enough and explains things simply with examples, with managing, closing, and opening positions profitably. I want to make sure that this course right here teaches you everything, even if you're a complete beginner, to helping you understand how to make money option trading. Here is the full list of timestamps for everything I'll be covering in this course, as well as you can find them on the YouTube play bar. I could easily charge, and I have charged, thousands of dollars for this type of education, and now I'm giving it away for free. And this full course is especially designed to take you from a complete beginner, even if you don't have anything about option trading, even if you don't know what an option is, to a confident option trader equipped with the knowledge to create a safe, consistent, and pretty much completely passive income online. This way you can retire early with options. That's exactly what I've achieved after many years. Yes, it does take years to actually scale up a portfolio to 7 figures. I'm not going to sell you a fake dream and tell you that this happens overnight or this happens in 1 week. This definitely takes time, but is worthwhile because this is something that you can do on the side. It only takes about 1 hour per week to actually scale a passive, safe, consistent income. I have 10 years of experience. I started at 19 years old with just $2,000. Now my portfolios sit at $2 million, another $2 million, and I have another portfolio that I'm scaling with a small amount of money. I went from pretty much $2,000 in my bank account to having a multi-million-dollar portfolio, allowing me to retire before the age of 30 and travel around full time. And I don't say this to brag, I'm saying this to show you that anybody can do this. So with that being said, let's jump into it and learn how to actually trade options. So first of all, what is an option and how is it different from a stock? Well, we all know what a stock is, right? When you buy a share of a stock, you're just buying a really small percentage of a company, and you ideally want that company to rise in value. So say you buy a share of stock of Apple, when the company, raises its value, so does that one share of stock that you bought. So if you bought a stock for $100, you're hoping that it goes up to 101, 105, 110. That's what you want to happen with a stock. Now let's say that you want to buy one Apple option contract. Yep, that's right. You have to buy an option in the form of a contract instead of a share. Okay, so an option is very similar. Instead of buying the shares, you're buying an option, and that option just gives you access to those shares. So when you buy an option, you are betting on the stock also going up, but it's a little bit different. Okay, say you only pay $100 for an option, that option can raise a lot in value. It can go up from 100 to 200 to 300. You can many times your money, versus a stock. It's a very small amount of money, the same amount of money, but it does not rise and fall the same as an option does. See, an option is almost like a leverage tool. Okay, imagine I have a lever here. Okay, if I push the lever a little bit, this option value goes up a lot. It also does go down a lot if the lever is not going up. Whereas a stock, there really isn't a lever. It just goes up and down.
So here's how it works. Let's say a stock is trading at $50 per share and you really like that stock. You think it's going to go up a lot in the next 30 days. In fact, you like it so much that you want to buy 100 shares of it. But that would be pretty expensive, right? That would cost you $5,000. Now, I see you looking at this stock and I already own 100 shares of it. I like this stock too, but I don't think it's going to go up past a certain amount in the next 30 days. So I say, hey, I'll make a deal. I think the stock will stay below 55 in the next 30 days. So if it goes to $55 or higher at any point in the next 30 days, I'll give you the option to buy my 100 shares at $55 per share. Even if it goes to 60 per share, you can still buy it for 55. And if you decide to exercise that option, the broker will buy it at $55 per share for you, then immediately sell that at the market price, and you get to keep the difference. So you don't have to spend any money and you still get the same benefit as if you had bought 100 shares of the actual stock. But if you want that option, you have to pay me $200. So if the stock goes up to $60, you have the option to buy it at $55 using the broker's money and immediately sell it at $60 for a profit of $5 per share. And since I have 100 shares, you will make $500. But since you paid me $200 for that option, you actually make $300, which is still pretty good. Now, if you're wrong and the stock goes down, stays flat, or doesn't go above 55, You don't lose any money because you never owned the stock in the first place, but you do lose the $200 that you paid me for the option. That's essentially how an option contract works. That specifically was how a call option works, and there are also put options where you're betting on the stock going down, but we'll get into that in more detail later. Now let's go back to the same scenario, but this time I'm going to teach you the option terminology that we use. Strike price. So in that scenario, 55 was what we call the strike price. The strike price is a price that the buyer and the seller agree on, at which the buyer has the option to buy or sell shares of a stock. If the stock goes past the strike price, we call it in the money. Otherwise, it is considered out of the money. Expiration date. The expiration date is the date at which the buyer no longer has their option. So in that scenario, I kept mentioning 30 days. That means you had 30 days for the stock to hopefully go above $55. But the expiration date can be as short as 1 day or even 0 days or even as long as multiple years. So there's a whole lot of differences in the expiration date. We'll be talking about later the best expiration date to pick. Exercising an assignment. When the buyer exercises their option, that means they're going through with the deal. On the other side, the seller will get assigned if the buyer exercises their option.
So let's talk about the buyer and the seller, okay? For every option, there is a buyer, someone who's buying that option, and a seller who is selling that option. The buyer and the seller are basically betting against each other. So only one person can win. That's why they call this a zero-sum game. That's why option trading can be hard if you don't know what you're doing. There are a lot of sharks out there trying to make money. But the good news is Uncle Henry here has been doing this for a very long time. So if you stick through this video, I'm going to show you how to actually be a winner in this overall game. When different things happen to the stock, like it goes up or it goes down, or if it even stays completely stable, this will depend on the movement of the option. Depending on what type of option contract that you have, and there's only two, there's a call option and a put option. Okay, depending on this movement, both people can make money or both people can actually lose money depending on the option that they are buying. There are calls and puts, which is very simple, but you can also combine calls and puts together. And we're going to talk about that in a little bit. So don't get confused just yet. We're going to keep it very simple and we're going to build up and scale as this video goes along. And we're actually going to cover even the more advanced stuff later on in this video. We're going to talk about spreads. We're going to talk about buying strategies like bull call spreads, iron condors. We're going to be talking about a lot of good stuff, as well as technical analysis, as well as managing your position properly, cutting your losses, making more profits. We're going to get all into that in just a moment. So this is a much more different from your standard stock trading strategy. An option trading strategy or the option market is a little bit different only in the sense that options move differently, but the market is very similar. It's still the same stocks. It's still the same movements up and down on the stock, just the option behaves differently. If you have a lot of questions, don't worry, that's completely normal. I'm going to answer all the questions you might have by going into my Robinhood portfolio. This is a trading platform, by the way. You're welcome to use any trading platform that you want. I'm just a coach showing you. And if you do want to learn from me personally, there is a link in the description for my personal Discord community. So now that I have Robinhood open, I'm going to search up Apple and click Trade Apple Options. Okay, so I'm going to go to the top here. I'm going to type in AAPL. So AAPL. Once I click into that, you can see I do have 7,000 shares right now. I'm going to go into trade right here on the bottom right and trade options. So right here, you will see right away, there is something called an option chain essentially. There's different expiration days, and this does look different if you're using a different broker. So I can go to May 17, I can go to May 31, okay? And regardless of what expiration I go to, it still says buy, sell, call, put, okay? So essentially, it's always going to be saying buy or sell, a call or a put. So there's only 4 things you can actually do. Now, don't get intimidated by this screen. I know it looks very complicated to beginners. Only pay attention to the numbers I'm explaining, because if you try to take everything all in at once, you might get confused. So as you can see at the top, you can either buy or sell an option. You can buy or sell a call or put option. So let's talk about buying a call option on Apple. If I go to buy, call, now I get to select the strike price, okay? So I can pick a different expiration day. So whether I go for, let's just say we're gonna go out into the future, and we're gonna go for October 18, okay? So if I click October 18 right here, that is the expiration day. This option will be good until October 18, okay? That's when this option officially expires, and that's it. That's when you actually have your profit or loss if you hold the option to expiration. Now, this may sound a little bit confusing, but although options expire at a certain date, you're actually able to trade them before or after that expiration date. So let's say that I go ahead and I buy a call option. Let's go to 190. Okay, you can see here if I click into this, it will give me the option to buy Apple 190 call for 10/17 expiration. So the price that I picked here, the 190, is called the strike price. That's basically where I want Apple to go to. So if Apple goes to 190, that means I'm going to break even. All right, if it goes above 190, that's where I can make money. The expiration is 10/17. That's when this option expires, and that's it, sayonara. Hopefully I go above 190 by the 10/17 expiration, or ideally I'm way above the 190 call strike price. So you'll notice a few other things on the screen right now. So you can see that there is a bid, there's an ask, okay? If you're buying an option, you will have to buy closer to the ask. If you are selling an option, you will have to sell it closer to the bid. Now, we're just talking about buying an option right now. So if I go to one contract, and I go into this limit price and I click 9, I'm picking 9 because typically when you see there's a bid and an ask, you're typically going to get the middle price. So right here it's $8.90, $9.10. You're going to get filled right in the middle for $9 in most cases. You can see here there is a max cost. In my program and in my Discord community, I'm teaching people how to mainly sell options for income. But for this example, right here, this is a buying strategy. Now, I don't love buying strategies because buying strategies are very high reward, but also a lot higher on the risk versus selling strategies. We'll talk more about that later in this video. But in this example, this will cost you $900.03. There's a little 3-cent fee, regulation fee from Robinhood now that they just recently implemented. So if I go to review this order, you will now see that I can easily just swipe up and submit this order. And this order would buy me one call option for 190 strike expiring in October 17, 2024. If you're watching this video in the future, by the way, this is the same logic, the same thought process that you can apply over and over again. Option trading doesn't change. In fact, I've been using the same option strategies for the past 10 years and I've been very profitable. Now, I want to go back here and talk a little bit more about mindset and how to manage a strategy just like this. So if you go into the middle here, you'll see that I have an expiration day that is October 18. All right, now this is an option that expires many days into the future. You can also trade options that are 30 days from expiration. Heck, 1 week from expiration, 1 day from expiration. You can even trade options that are expiring on the same exact day. That means that I have an option to buy Apple here that's going to be expiring in many months. However, I can also go to a different expiration day. For example, I can go for May 10. As I'm making this video, that would be a very short expiration day. You'll actually even notice here that if I click the 182.5 call option here, it's going to be trading for a lot cheaper. It's only trading for $2.70 per contract. See, the thing is about options, the farther out you go, the more expensive they get. The reason why they're more expensive is a lot more stuff can happen from now until that long expiration date. But if you buy options that are very short term, they're going to be a lot cheaper. And that's because the market knows and they're pricing in a proper premium to account for the risk that a buyer or a seller is taking. Now, to have any option, to buy any call option, first, I need to pay for it. And this is what the number in the green right here looks like. So it's either 270. If I go out farther out of the money, it's going to be cheaper. It's going to be 148 or 71 cents even. So the farther out of the money you go, the cheaper the premium becomes. You can see that the price is different for every single option. The price of the premium is calculated based on multiple different factors. One of them is the strike price. The further in the money the strike price is, the more expensive the premium is. So if this option's in the money, basically, since you see the Apple's at 181, if I were to buy a call option that's at 180, it's going to be more expensive. If I buy something that's 175, it's even more expensive because right here it already has intrinsic value. See, options are really priced based on two different things, okay? There's intrinsic value, there's extrinsic value. Intrinsic is how much are we already in the money, all right? So here at 175, call option, it's already in the money by $7. It's already in there. Apple's already above 175. That's the intrinsic value. Now the extrinsic value would be this. If I go up to 190, 34 cents right here is pretty cheap, but why does it cost anything? Well, there's no intrinsic value at all. Apple is not at 190. It's not really even that close to 190. But the reason why this has value is because there's a few other factors at play, okay? One of the factors is there is a chance that it'll go into the money. There is a chance that Apple will go up. And specifically, as you see on the screen right here, the delta is 0.12. That means there's a 12% chance that this option will go into the money. Isn't that really cool? There's a 12% chance. You know exactly, based on the delta, what the chances are of the option expiring in the money at expiration. So by this expiration of 5/10, okay, May 10th, there is a 12% chance that Apple will be at 190. Not that much. However, it's something. That's why this option is so cheap, because there's actually a small chance that it'll go into the money. Now, this is one of the extrinsic values, okay? There's also some other extrinsic values like volatility, okay? If volatility increases, this option will also increase. So what's really interesting is you can wake up one morning and realize that your options are worth a lot more money, and that's because option volatility actually favors the option buyer. So when the market's more volatile, options become better because you don't want to take the risk of buying shares. You get a much better price just buying a small amount of an option, and if the market is crazy, this option can make a lot of money, and that's why these options become more valuable with higher implied volatility in the market. To help you remember, you can just think of in the money as all the strike prices that would be favorable to you, where you've already made money if it were to be at expiration. So if a stock goes up a lot, let's say you have Meta, it goes way past, your strike price is, let's say 500 and your strike price is 450, perfect. That means you made a lot of money if you have bought a call option. Now, on the flip side, the further out of the money, the cheaper the premium is going to become, because I'm only getting the option to buy the stock at a more expensive price than I could get it at the market today. So if I'm going to be paying for an option, I really don't want to pay that much, because I'm essentially taking a bet. Hey, this stock will go up a lot, I think, and I'm willing to pay X amount of dollars for it to potentially go up. And if it goes past my strike price becoming in the money, then I'm going to be profitable. But if it doesn't, I lose whatever I put in for this option. So you can lose 100% of what you pay for an option. So for that to even be worth it, I would need the stock to go up and be out of the money from, being out of the money to becoming in the money. And that means the stock may have to move 10 or 20%. It just depends on your strike price. But typically, if a stock goes up by 5%, an option can go up 10, 15, or 20, even 25% easily. And that's because with options, you're putting up a very small amount of money. You do need the stock to go up a lot in the case of a call option, but if it does go up a lot, you start multiplying your money from, let's say, let's go over another example actually, because I want to show you what this would look like. All right, so I'm going to pick an option, let's say May 17, and I'm going to buy an option right here at 185, okay? So you can see here that it says break even. The break even is 187.16. Now, the reason why you have this break even is you take the strike price of 185 and then you add $2.18 to get 187.18. Robinhood is kind of mispricing this by 2 cents here. But at that point, that's where you break even. Now, if it goes up, for example, to 190, you have a total gain of 190, okay, minus the 185 strike price, which is $5. Right? You paid 218, you have a profit of 5. You doubled your money, okay? Apple went from 182 to 190. It only moved up $8, but you, however, have doubled your money, all right? If Apple went up to $200, all right, you would have a total profit of $15. You have put in 2. So you went from $2 to $15. You have multiplied your money over 7 times. Whereas a stock investor, if the stock goes from 182 to 200, he has made 10%, whereas you have made 700%. So you can see how valuable an option can be. Also, you do have to realize that if the stock goes to 184, the stock investor would make $2. However, in this example, you would actually lose $2 because Apple did not go into the money in this example. You would be below the 185 strike price that you have purchased. Therefore, you wouldn't make any money. Remember, more out of the money means that it's riskier for you to buy that option. Therefore, the premium is cheaper. More in the money means it's riskier for the seller of the option and safer for you as the buyer. So the premium, aka what you pay up front for an option, is going to be more expensive. The second metric that determines the price of an option premium is the expiration date. So right now you have seen that I had an October expiration. Let's just say that we had an expiration of 30 days. Following the same principles of riskier options being cheaper premiums and safer options being more expensive premiums, it's going to be way more likely that an option that is going to be more cheaper is going to expire a lot sooner, and an option that's going to expire a lot later is going to be a lot more expensive. It's also going to be way more likely that an option is going to become more favorable for you the longer the option is to the expiration date. That's because there is more that can happen. So the market perfectly has these options priced in, and oftentimes a lot of people do say that it's hard to trade options because a lot is priced in. In fact, one of my students asked me, should I close a position and open up this one or this one? They give me a couple different options, and I usually tell them that both of these options are actually very, very similar. Like if we go back to the example of Apple being at $200 in market market price. And me picking a strike price of 185, aka having an option that, I want to buy the shares at 185. If I pick a really long expiration date, like 2 years, it's way more likely that Apple is going to be at $200 or $250 in 2 years. At the same point, during the next 2 days, it's probably not going to move anywhere. So that's why the option premium is going to be a lot more expensive the longer there is until expiration. The third thing that determines option premium is how volatile a stock is. Now, I've talked about implied volatility. So basically, if it tends to go up and down by very large amounts quickly compared to, say other stocks that don't go up that much at all, that stock is going to be deemed more volatile by the market, okay? Like take Tesla, for example. Tesla is a pretty volatile stock because the price goes up and down a lot. So the premium for Tesla is going to be more expensive than a stock which is very stable. Say Kraft Heinz, they're selling some ketchup and the company is very stable. It's not moving up and down and it's not as volatile as Tesla, which is innovating. It has a lot of deliveries one quarter, and the next quarter, Elon Musk says something crazy and the whole market reacts and the stock is moving up and down a lot. So that implied volatility is just going to be a lot higher. That means the options are also going to be priced higher. Now that's partially a good thing because if you're selling options, you get more premium. And if you're buying options, well, Tesla moves up and down a lot. So you could make a lot of money. So it is fairly priced and the market is pricing in this extra movement to compensate for both the buyer and the seller. So it makes sense for both. Because if we go back to an example like Apple being at, let's say 200, if Apple was extremely volatile and it went up and down by 10, 20, $50 a day, trust me, this option would not be worth a couple of dollars. It would be worth tens, if not $20, because people would be scared. Who in their right mind would sell an option on Apple, right around where it's trading at right now? If the stock was moving from 200 down to 100, down to 50, if it was going like this, trust me, that premium would be very high. It would have to really compensate an investor for wanting to sell that option because, again, this is a game of both buyers and sellers. So they both want to be correct and they both want to be compensated fairly for buying and selling. Just like everyone in the world wants to be compensated fairly, so does the option market. Now, here's where options get really crazy, really powerful, and potentially really dangerous, but only if you don't know what you're doing. Remember at the beginning of the video when I said that stock comes in the form of shares, but options come in the form of contracts? Well, one contract actually does not equal one share. One option contract actually controls 100 shares of whatever stock that you choose. But this is different from just regularly buying 100 shares of Apple stock, because if I want to buy 100 shares of Apple stock, that's going to be $17,000. But if I buy an option contract, as you already saw, it's a couple $100. You're putting up a very small amount of money to get a very huge benefit. And if I up this to 2 contracts, now I'm going to be able to share or control 200 shares, 3 contracts to 300 shares, and so on. But let me bring it back down to one contract for now. So if we compare the hefty price of $17,000 upfront for the stock versus a total premium upfront of the option contract, which is $200, what is better? What seems better to you? It seems crazy, right? What's the catch? How can this option cost $200 and give you the same value? Well, that all depends on moneyness. Is it in the money or is it out of the money? And yes, I know, even from the looks of it, it can be really crazy risking $17,000 up front. Most beginners don't even have $17,000 to buy 100 shares. Even, if they could buy $17,000 worth, it might be really scary. But an option contract that costs $200 is a much easier way to get into the market and learn about trading and not have to have all that capital to really learn with. You can start scaling with just a couple $100. In fact, I have many videos on this channel about scaling a small portfolio, and I actually specialize in taking $7,000, to $10,000 accounts up to $20,000 and even $30,000 in 1 year, and that's in my Discord program. I call that my small account scaling challenge. So let's keep going. The regular stock, you're essentially risking $17,000, but for the option, the maximum amount of money that you can lose is the premium that you pay for that option. You can't lose more than the premium. If you pay $200, that $200 is gone, but the good news is you can't lose more than that $200. Either that option is going to make you a lot of money, or that option is going to lose and you're going to lose your $200. Again, not more than 200 if you put 200 in. Because remember that you have the option to buy the stock at that strike price, okay? If you buy a $200 strike call option, you have the option to buy 100 shares. Now look, you don't have to actually buy the 100 shares. Again, if it goes to expiration, the stock is at 250, the call option means that you're buying 100 shares. However, right before expiration or any time before expiration, you can just sell that option. It's going to be a lot more valuable than buying 100 shares, especially if you don't don't have the money to do so. And now you might be wondering, well, what is the catch? What are the downsides of how this trade could play out? That's exactly what I'm going to show you right now. So let's go through some actual real life scenarios and I'll show you how they can play out. All right, so now we're gonna go into my portfolio and we're gonna look at a stock that is potentially attractive for buying a call option. Now I'm gonna be a little bit more serious, and instead of just making an example, I'm actually going to show you something that I actually want to do when the market opens up and why I want to do it. First of all, you can see I do have many options here, and Apple is one of my favorite positions. So I'm going to go through my watch list. And by the way, you should have your own watch list. If you want to be a successful investor, you don't want to look at whatever is hype. You want to look at a specific stock list that you build of stocks that you really like and that you believe in. So for example, I actually want to take a look at Starbucks because recently, if I look at the 1 month chart, you can see that Starbucks went down 17% in the past month. They didn't do so well. Now, some people might say, oh, wow, the stock is going down. But look, nobody actually knows. What happened in the past is the past. What's going to happen in the future, nobody knows. Not Warren Buffett, not a billionaire, really nobody. But I'll tell you this, when a stock goes down by 17% in 1 month, that's actually a very good time to potentially use the option buying strategy of buying a call option. Because let's say that this stock may have a shift in momentum. Okay, what that means is the stock is going down, 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 down. And instead of buying shares, which could be a little bit scary, some people call this a falling knife, okay? It's a falling knife, the stock is going down. You don't want to catch it. You might feel that pain. You might say, oh, I bought it at 73 and now it's at 63. It goes down $10 more. You might feel stupid. You might feel that this is really risky. And in many ways, it is. But a call option would be very different here. A call option, you put up just a couple $100 as we mentioned. And let's say that the stock reverses and it goes back from, 73 back up to, let's not get overly optimistic and say it's going to go back up to 88. But let's just say that in the, the not too far future, it might go back up to, maybe 83, 84, something like that. Heck, even 80, that's fine as well. So here's what you would do. You would go to trade options. And in fact, I'm actually very, very interested in purchasing an option like this. I think that it's a very good idea, especially right after a stock has a lot of disappointment. Because what happens is when a stock has a lot of disappointment and the whole market basically sells off that stock, a lot of people lose confidence. Well, that price is already really depressed. People went from enthusiasm and ecstasy and excitement down to really depression and not having any hope. That's actually a good time to buy a stock or a good time to buy an option because that option is undervalued in many ways, okay? And in many cases, people are not so optimistic. And when they become more optimistic about the stock's price, will go up and the option will also go up in value. So again, I'm going to look at an expiration. Now, this stock went down a lot really quickly. So what I want to do is I don't want to pick a short-term expiration. If I were to pick an expiration really short-term, I'm not giving myself enough time for the option to actually make money or the stock to recover. So what I'm going to do is I'm going to pick an expiration day that gives me some time. So let's go for July 19. So as I'm making this video, that's going to give me about, 2 months. All right, so again, I said that I think the stock can go back up to, maybe $80, all right, maybe $80 per share. So what I would do is I would buy call. As you can see here, I'm at buy call. And I can have a few different options, okay? I can go for an in-the-money option, so I can go for 65, okay? You can see here the break-even will be $74. I can also go for 70. I can go for 75. I can go for 80, but 80 wouldn't make any sense, right? Because we just said that our base case scenario is that we think the stock will go back up to $80. So buying an $80 call doesn't make any sense because if it just goes to 80, we can't make any money. It's not going past 80, therefore we're not going to make money since we're not going to be in the money at expiration. Now, a common question is, why don't you just keep going lower? Why don't you just buy something like the $40 call? Well, the truth is you actually can. You can buy a $40 call, and you can see here that the break even is actually pretty good. It's at 73, okay? Now, the thing is, you do have to put up more money. So you can see here that the premium here is $35, which would actually be $3,500 because each option is worth 100, shares. So you wouldn't really want to do that. You would want to pick a kind of a sweet spot. So that sweet spot for me would be about 70 or 75. Let's use 75 as an example. So if I were to buy the $75 call here, which would probably be my number one choice, I would go for this. This would be a slightly out of the money option. So if I buy the $75 call and I spend $2.24 for it, that means that if the stock goes up to 80, here I'm going to have a $5 gain, okay? I'm putting up $2.24. So I'm basically turning $2.24 to $5, doubling my money. So if I go into this right here, and I just buy 10 contracts, I can put in $2,240, and my maximum gain will actually be $5,000. And I just said maximum gain. I meant we will make $5,000 if it goes to 80. Our actual maximum gain is going to be unlimited. You can see right here the maximum profit is unlimited, because if Starbucks goes to 85, 90, 200, 1,000, you keep making money as long as the stock is going up. So you don't have a cap on how much money you can make. However, you do have to understand that there is no way that Starbucks will be $500 per share by, next couple of months. There's absolutely no way. That is actually impossible, because the stock, I'll show you how to actually think about this. If you look at Starbucks right now, you can see if I scroll down here that there's a different statistics, and the market cap is 82 billion. There's no way that a stock can basically double its market cap if it's already a big company. So this company, Starbucks, can't go from 82 billion to 164 billion. That's just not going to happen. So you do have to be logical with how you're trading options. You have to understand where the stock can potentially go. And we will talk about that in this course when we go over the technical analysis section. So let's go over some scenarios so you understand exactly what can happen, different scenarios, and how they can play out. So again, we're going to go to the July 19 expiration. And if I click the 75 here, let's go over what can potentially happen, okay? So if the stock is, say, below 75, let's say that Starbucks actually goes down in value from the current $73.89 to 71, 69, 65, whatever. All of that is going to be meaning that you're going to lose the $2.24 that you put up. You're going to lose it. If Starbucks is below 75, you're done. You've lost the money, okay? That's the first scenario. If it's below the strike price, you will lose money. Now, if it hits 75, you actually still lose money, because even at 75, you have paid $2.24. If it is at 76, you've made $1, but you've spent $2.24. So you still lost $1.24. If it goes to $77, then you have made $2, but you paid $2.24. So now you lost 24 cents. So you see, you need the stock to go to $77.24 to break even. And then you are making money from that point on. So if the stock goes to 80, you made $5, you paid $2.24. If it goes to $90, you have made $15, okay? And so on and so forth. You can use this basic math to understand how much money you make. So we just had gone over how to buy call options, but there's a whole another side of it, which is selling call options. So the option seller is the one who writes the contract in the first place for the option buyer to choose from. Okay, so the option buyer is choosing a strike price, and that seller is also picking a strike price and expiration date and all that stuff too. You have to pick the strike price that you're comfortable with selling the shares of stock. So when you're buying a call option, you're saying, hey, I want to buy shares of this company at 200. Okay, but when you're selling a call option, you're saying I'm ready to sell shares at 200, your strike price, okay? So when you're selling call options, you can't just sell a call option. The reason why you can't just sell a call option is because you do need the shares. With the buying a call option, you don't need the shares. You just buy the call option, you're good. Now, when you're selling a call option, you do need 100 shares. This is a more amount of money that you have to invest. So covered calls are, I wouldn't say they're more advanced. They're very, very easy. However, you do need more capital to write or to sell a covered call. When I say write a covered call or sell, that's a synonym, okay? So writing and selling is the same thing. You're selling a call option. Now, if you were just to sell a call option to the market, you'd be at very high risk, because remember, the call option buyer who buys the call option has unlimited upside. They can make as much money as they want. So if you were just to sell a call option, that'd be risky. You would be potentially giving yourself unlimited risk, which I would never recommend. I would not recommend you do that. Plus, you're not going to be able to do that anyways. Your broker won't allow you to if you're a beginner. You must have a very large portfolio size, like myself, to sell naked call options. It's called naked call option selling, okay? Don't recommend it unless you're advanced, unless you've been coaching with me for over 6 months. So let's talk about now how this looks like, okay? Again, you need 100 shares to sell a call option. If you own 100 shares, those shares rise in value, and you have a covered call, or you've sold a call option, that's okay. Because if that call option goes up in value and that person wants to basically get shares, they want to exercise their right, the buyer of the call option, you're covered. You're covered. You have the shares to give to him, okay? If that stock goes up a lot, that's okay, because you have the shares to give to that person. Whereas if you just had a naked call option, you don't have the shares. So if he wants to buy to exercise his rights, you're in big trouble. The other different thing about selling options is that you get paid upfront for selling the option. That's right. Instead of having to spend money, you actually get paid. You get to collect income instead. If you remember, the premium that the buyer had to pay up front and how the premium goes up when the option is more likely to be favorable for the option, well, that's also true for the seller. As the premium gets higher, it's more attractive for the seller to actually get paid that premium. That premium is what you're getting paid upfront for the risk that you're taking, because the risk is for a covered call or selling a call that you may lose shares of the stock. Now, the good news is your risk is actually losing the stock at that strike price. So for example, if you buy a stock for 100 and sell a covered call for 110, well, you risk losing the stock at 110. But the thing is, that could be a good thing. What if you want to sell the stock for 110 anyways? That's why selling options can be very favorable, because you get paid to sell an option, and then you also get to pick the strike. So you have full control. You have so much control as an option seller. You know exactly the strike price that you want to sell at. Whereas the option buyer, you have some control, of course. You know what strike you're going to buy at, but you don't know where the stock is going to move. In the other scenario of selling options, if the stock doesn't really move anywhere, it just goes sideways, that's fine. If it goes down, well, that's not great, but if you were to own the stock anyways, well, now you're still losing the same amount of money, but you get the option premium. So you have collected income regardless. If the stock goes down, you have income. If the stock goes sideways, well, that's fine, you got paid income. And if the stock goes up, you still get paid, but now you just have to give up your stock. So for example, if you pick a really far out of the money option and you pick a really far out of the money strike price, in this case of a call option, that means that the strike price will be way above the market price. So it will be very unlikely that the stock will shoot up that high. Meaning that is actually not very valuable option for the option buyer. That means that the premium upfront that you will be getting is actually pretty low. However, it's also very safe and consistent. It's actually just some income in your pocket, and most likely you won't even lose your stock anyways. So in this scenario, you can collect some income every single week, every single month, or every couple of months by selling options and not even lose your stock. That's actually the way that I like to go about it. And we can see that if we look into my Robinhood app right now. I'm going to pull up some examples and show you how collecting income actually works and how much money you can actually make on a consistent basis. All right, so we're going to be looking at Palantir. This is another example. I do have some shares of Palantir right now. I have currently a little bit over 3,000 shares, which makes up about 4% of my portfolio value. So if I go and trade Palantir options, actually you can see here, this is actually a perfect example because I'm currently running a covered call strategy. You can see here how I have sold the $25 call options. So right here, you'll see that I have sold $25 calls. They're currently worth $1.18. But let me just show you an example from scratch. So if I go to trade options, okay, and now I'm going to show you what selling a covered call looks like. So let's just pretend we have 100 shares of Palantir. So now if I wanted to, I can go out about a week. So let's go to a week out and I go to sell call this time. So instead of buying calls, now I am clicking sell call. So if I wanted to sell a call, let's say I wanted to sell with a strike price of 24.5, I'm going to sell here 24.5. Now you will notice that if I click continue and I go for one contract, I can actually make $132.97, or basically $133 by selling one call option at 24.5. That's for 1 week. So I can start making $130 per week just from 100 shares of Palantir, which wouldn't be too expensive. Buying 100 shares would be about $2,000 something. The further into the money that I go, the higher that I get paid. You can see right here, that makes sense by, going down 24, 23.5, 23, the premium is increasing. And also if I did want to increase the expiration day, so let's say that I wanted to go out all the way to January 2025, you can see here how the premium is actually really, really big. So you can buy 100 shares of Palantir and then you can sell a $25 call option. You would actually get paid here over $400 and you're only putting up about $2,000. So, you're getting 400, you're putting up 2,000. That is a percentage return that is over 20% for 1 year. If I choose a longer expiration day, like 2 years out, the premium's only gonna go up. And, the stock is more likely to basically go up to that strike price. So you are more likely to make money when you do go farther out. That's not as exciting, but that is more consistent. If you want to sell options that expire way into the future, you will get paid as the option seller because, well, you're getting paid for the risk of potentially losing your stock. But again, losing it is not that bad because here it doesn't mean that we lose any money on the stock itself. We're still buying the stock for $24 per share and then we're selling it for $25 per share. And we're getting paid to literally sell the stock for more money. So the only real risk here, and this is not really risk, it's more opportunity cost. If Palantir or whatever stock you're running this strategy on goes up a lot, well, you don't necessarily get to make all that money. You get a predetermined price. So here you get $25 plus the $4, which would be the $29 as your break even. That doesn't mean that you start losing money when it goes up. It just means that you can't make more money. The reason why you can't make more money is you will get assigned for sure. Someone will want to buy the shares from you. You will lose your stock. And when you do lose your stock, well, you basically lost it at 25 and then you got paid $4.35 for this trade. So you have a basically guaranteed exit if the stock goes up. Now, this is the fun part. Let's see what happens to me as a seller in different scenarios. I'm going to be using some real numbers here because I want you to understand exactly what will happen in different scenarios. So if it goes up to just 25 exactly, my profit would still be the difference, which is 25 and the 24.16. So I'll make $84, excuse me, plus the premium of $435. So while the stock investor only made, $85 or so, I've actually made the same $85 plus $400. So I have gone way better than just a regular stock investor. If the stock goes up to 26 or 27 or 28, I'm actually better off in all of these scenarios until 29.40, which is our break-even price. From there, I won't be better off than a stock investor, but I will still be pretty good off because I'm still going to be ending up with a good return. That means that you as the option seller basically are agreeing to sell the stock at a certain price. You're getting paid for that contract, and then you pick the expiration day. So you pick how long you want to wait. So if you want to go really short term in expiration, you can do weekly option trading and make $100 a week or so based on $2,000, which would be an insanely high return. It may not seem like it's so much money, but at the same time, if you're consistently making that amount and you scale your portfolio, you will get into the retirement zone. You'll be able to replace your income, and you'll be like many of my students who, I have a student named Denny. He was in my program years ago, but I like to bring him up because he was a one-trick pony. He had one option strategy. He had $300,000 and he was making $6,000 to $10,000 per month consistently every single month for basically 12 months per year. Now, he does have some hiccups here and there, and that's because basically the market does go up and down, and sometimes we don't have winning months. If I told you every single month was a winner, I'd be a complete liar. But in the example of Denny, he's doing really good consistent income just based off one strategy. So this option trading stuff, you may think it's hard, but it's really not. As long as you master this stuff, which doesn't take that much time, you just need to master the fundamentals, the basics, basically the simple math. You don't have to have any high level of mathematical ability. You just have to sell, for example, a covered call. You can make $5,000 to $10,000 per month. Now, for this example, and for basically collecting premium, what you want to consider is that collecting more premium is better in most scenarios. However, you don't want to go for in-the-money options because here with the covered call, it's a little bit different. When you go for an in-the-money option, you truly are cutting away some of your opportunity to make more money. Because in this scenario, if I go to, let's say 23, my break even here is 25, which is okay, but it's not really giving us that much upside. You always want to go for a slightly out of the money option. So what I would do is I would go for 24 and a half. I would go for 25. I would go for 26. I would give yourself some room for upside because not only do you get the premium, but you also get some upside for the stock itself. Now, in a scenario that the stock goes down, again, you will lose money, but that is just the basic laws of how the market works. If the market goes down, you will lose money, regardless of what market you're trading, not even option trading. In any market, even if it's used cars, you will lose money when the stock market goes down. And that is just something that you have to deal with. And the way I get through this is I'm always dollar cost averaging, which means that I'm always buying more when the market goes down, or I'm simply being patient and waiting for the market to recover. I do have a story where I actually got my father into investing, and I have been telling him that he needs to dollar cost average, and he didn't really listen to my advice. He said, I'm gonna wait and see if it recovers. But the thing is, with dollar cost averaging, if you buy a stock at 100 and it goes to 90, it is really, really smart to buy more at 90, because that way you are reducing your cost from 100 to 95. Well, if you buy one share for 100 and you buy a second share for 90, your average price is now 95. So all you need to happen is the stock needs to go back up to 95 for you to have a break even. But if you don't dollar cost average and your average price is 100 and it just goes down to 90, now it goes back up to 96. In the first scenario of dollar cost averaging, you would actually make $1. The second scenario of not dollar cost averaging, well, you didn't make your money back. However, it's totally okay not to dollar cost average if you just don't have the money. It is okay because the market does go up on a long-term basis. And option trading, the way I do it and the way I teach it to my students, is that I want to go for safe, passive, consistent income. And even in the worst case scenario, I just have a simple matter of time to break even. So if the market is down, actually options are really good because they're hedging your portfolio. So when you're doing a covered call strategy, you're actually more hedged than the average stock investor. So when the market goes down, you're actually losing less money than the market. So it's actually very beneficial. The way that I trade options is actually safer than stock investing. It's safer than really any form of, crypto or futures or any other investment vehicle. I prefer options because not only can I make good high income, I can also do it at a relatively low risk. Now, this isn't as low risk as just putting your money in the bank and just getting a 1 or 2% return, but also who cares about 1 or 2%? We're after 20, 30, 50% per year. I've had years in my trading account where I have 7x my money, where I've taken $100,000 into $700,000. I did take a lot more risk. I was a lot younger, but that is very, very possible to scale a small portfolio very quickly. So look, as a buyer, if you're buying options, you just need enough cash in the case to basically buy that option. So if I were to be an option buyer and I go to buy right now, you see nothing really changes. I mean, just a little bit. It goes from $1 on the 25.5 call to basically $1.04. And that's just the basic bid-ask spread price. So if you look right here, I clicked in here, you will see that there is going to be a bid at $1 and an ask at 104. And that's what I mentioned in the beginning of this trading video, is that if you're going to be buying, you're going to have to be buying closer to 104. And if you're going to be selling, you're going to be selling closer to 1, which is the bid price. Now, you might be thinking, as a seller, if I have the chance to be forced to sell 100 shares of a certain stock, in the case of the covered call option that we are talking about, or selling call options, then what happens if I don't own 100 shares of stock, which would be really expensive, in the case that a company goes up a lot, like Apple? Do I need to have 100 shares? The answer is yes. In covered calls, you need to have 100 shares. In selling calls, you need 100 shares. In buying options, you never need the shares. You can buy options all day, whether it's a call or a put, as we will talk about shortly. So it does depend on the type of strategy that you're using. But in almost all cases, you don't need 100 shares unless it's a covered call option. The other scenario would be selling a put, which we'll talk about later, but you still don't need the shares. So you can basically get the idea of needing shares out of your mind and just treat options as a standalone vehicle aside from the covered call strategy. So, what we're talking about, the covered call strategy, is you do have to own 100 shares of stock, and that's because you are covered. That's why it's called a covered call, because in the worst case scenario, you are covered to not losing money. If you don't have the money to buy 100 shares of stock, you can also borrow money from your brokerage that you're trading on. This is called selling a call on margin. And yes, you can also buy options on margin as well. It can be very, very risky to trade in margin because you're using money that is not yours. That means if you lose a lot of money on a trade, you're going to be in a really, really bad spot. For this reason, I don't recommend that you use margin unless you have a very high level of trading ability and you also have a bigger portfolio. I do work with many clients that have a bigger portfolio, and we do lots of margin trading in a safe way without even paying any interest. That is in my Discord program. Again, feel free to join that in the first link in the description if you want to learn more. Now, I want to mention a few more things that you really need to understand. On some platforms, you can sell naked calls, which means you can sell a call without actually owning 100 shares of stock. This is very rare because Robinhood won't let you do that, and many other brokerages also won't let you do that based on your account size as well as your level of trading ability. So if you have a level 1 option account, level 2 trading account, you won't be able to do this. You need the highest level of permission in your brokerage account. Now, I'm not an expert on third-party brokerages, but you can always call your broker and ask them how to get that. I personally prefer to focus on much safer, really consistent option trading strategies myself because I want to go after consistent income. I really want to rely on option trading to fund my lifestyle. I am traveling a lot and I'm renting and really living a life based on my option portfolio. So it's really important for me that I have a consistent source of income. For me, I'm making over $80,000 per month trading options. However, in the beginning, my goal was just to make $2,000 or $3,000 so I could pay for my rent. And that brings me to a really good income right now, but it wasn't always like that. It has to start somewhere. So hopefully I'm part of your journey of starting option trading and really opening up your mind to the potential to making a lot of money with this one day. Even if you start off with making $100 a week, that's a fantastic place to start. Never feel shy or embarrassed about your starting point because we all have to start somewhere. So I'll show you more of that process later on in this course. So hopefully now you're starting to understand how both sides of a call option works, whether it's buying and getting that unlimited upside or selling a call option, which means that you do have to own 100 shares of stock, and you're still in both scenarios picking a strike price, where as a call option buyer, you're picking a strike price to, purchase, and hopefully that stock goes up. And as the call option seller, you have a strike price that you kind of hope does not hit. You hope the stock goes up towards that strike price, but you hope it doesn't really go too much past it, because if it goes past it, then you have to lose your shares. If it goes towards it, you're making money on the stock and you make money on the premium. That is the perfect case scenario. So again, let's say that you have a stock at 100 and then you sell a covered call at 110. You want that stock to go up to $109.99. If it ends there, you're going to be a very happy camper because your stock went up by $9.99, but it didn't hit the strike price. So that call option buyer, he lost everything. As a call option seller, you've already been paid when you sold that option, so you're in the perfect case scenario. And the seller receives a premium up front, but has to sell 100 shares of stock at the strike price if the buyer chooses to exercise it, which they will if the stock goes up into that strike. And this all has to happen within the expiration date. If the option expires without the buyer exercising it, the seller gets to keep their premium and their 100 shares. Cool, so now that you know call options, let's talk about put options. How do put options work? Well, a put option is essentially the opposite of a call option. There's still two sides. There's a put buyer and there's a put seller. There's always going to be a buyer and seller in all option trading scenarios. The buyer is buying an option to sell the stock at the strike price that they choose. So, unlike call options, a put option bets on a stock going down. So when you buy a put option, you want the stock to fall. This is why options are so awesome, because as a stock investor, basically you only make money when the stock goes up. Okay? With options, when you buy a put, you want the stock to fall. As it falls, you actually end up making money. So remember, with the call option, the buyer is buying the option to buy 100 shares of the strike at the strike price. And with a put option, the buyer is buying the option to sell 100 shares at the strike price. Since the seller of the put option is selling that option to the buyer, if the buyer decides to exercise their option to sell their 100 shares, that's fine. That is how it works. So the buyer of a call wants it to go up, the buyer of a put wants it to go down, and they want to sell their stock. So in one scenario, they want to buy the stock. In the other scenario, they want to sell the stock. So the seller of the option must buy the stock from the seller. Just reversed. So just think about it like this. When you buy a put option, it goes down, you make money. When you sell a put option, when it goes down, you do get income, but now you have to buy it from the buyer. Now, as you may have guessed, the price of the put options premium works the exact same way as it does with call options. The more favorable it is for the buyer, the more expensive the premium is going to be. The less favorable it is for the buyer, aka more risky, the cheaper the premium will be. So let's go through some examples right now. A put option gives the holder the right but not the obligation to sell Starbucks at the price that you choose, the strike price, within a specified period of time. This means that if the price of the underlying asset decreases below the strike price, the holder can still sell at the higher strike price, thereby profiting from the decline in the asset's value. I'm going to give you an example right now. So Starbucks stock price, $73, and you buy a long put option with a strike price of $70. Okay, you pay a premium for the put option. Let's just say you pay $1, hypothetical example. As Starbucks falls to $65 per share, here's what it's gonna look like. With the stock price dropping below the put option strike price of $70, the put option becomes in the money. So for a put option, it's in the money when the stock drops below the strike. For a call option, it's in the money when it goes above the strike. So for a put option, you want it to go down. When it goes down, you are making money. So this means that the holder of a put option now has the right to sell Starbucks shares at the higher strike price of $70. So if Starbucks comes crashing down, you're perfectly fine with that because you get to sell it at $70 no matter what, because you own that put option. Even though the market price declines and it goes down to 65, that's perfectly okay. So the put option holder can buy shares at the market price of 65, and then he can sell at a higher price of 70, realizing a profit of $5. Since each option contract typically, in all cases represents 100 shares, the total profit would actually be 500, the $5 times 100 shares. So deducting the premium paid for the option, which we said was $1 or $100, that means we have $500 of profit minus the $100 that we paid, which gives us $400 of profit. That's the first example and the first scenario. I have two more for you about how a put option works if you're buying them. By the way, before I get into the second and the third example, I want to say this is a really good time for you to subscribe. I would really appreciate it. Plus, it will really help you out because I have a lot of videos that are coming out on a frequent basis teaching you how to make money option trading. That's all I really ask. Let's do another example, another scenario. The long put option in the prior example that we just did was, basically making us $400. But in this example, what I want to go over is going to be a different stock. So let's take Apple, okay? Let's say that Apple right now is around $175, and then we're gonna buy a long put option with a strike of 170, okay? So we're at 175 and we're gonna buy a 170 strike, okay? We think that the stock is gonna fall down and we're gonna pay $2 for this, okay? A little bit higher premium here. And let's just say that the stock does fall down, but it only falls down to 171, okay? So here's how the scenario unfolds. Since the stock price is above the strike price, the put option remains out of the money. The holder of the put option doesn't exercise the right to sell the stock at the strike price because, well, it's not profitable to do so. In this scenario, the put option expires completely worthless. As its holder wouldn't really exercise it, there would be no point. There's nothing to exercise. There is no intrinsic value. And there's actually no extrinsic value either when the option expires and there's no more time left. So it is a complete loss when the market price is above the strike price in the case of buying put options. The loss would be the premium paid for the put option, but good news is you can't lose more than what you pay when you're buying options. Therefore, in this case, the net loss per contract would just be the $200 that you paid, the $2 times 100 shares for each contract. So $200 would be your loss. Apple stock price fell from 175 to 170. However, it did not reach our strike price of 170. So this is an example of a put option that you can buy where, whether you want to hedge your portfolio, whether you just want to make money on the put itself, right? That's fine. There's two different ways you can make money when buying puts. You can make money by the put option going down, or you can save money when the stock goes down. You actually hold the shares and you're able to get out of the shares with your put option. You're able to actually exercise a long put option and get rid of your shares. But in most cases, you will probably be just buying a put option. So if you're just buying a put option, you would experience a full loss. Now I want to go over another scenario number 3. We'll just pick any other stock, maybe Chipotle, $3,000, okay? You buy a long put option strike price, okay? And you buy a put option for $2,900. So the stock is at $3,000, you buy a $2,900 put, and you pay $100 for the rights, basically, of buying this put option, okay? Now let's say that the stock does fall below your strike price. It falls to $2,850, okay? So the stock was at $3,000, you bought a $2,900 put, and now the stock falls down to $2,850. So you're in the money by $50. But here's how the scenario unfolds. With the stock price falling down to $2,850, in actuality, you are in the money by $50. However, because you have paid $100 in premium to get into the option, right? You bought the option for $100. Even though it's in the money by $50, you actually still end up losing because the premium you couldn't compensate for. You couldn't make enough money on the downside to compensate for the premium. So in this scenario, when the stock goes down from $300 to $2,850 and your strike price is $2,900, yes, you're in the money by $50. But because the premium paid was $100, okay, the $100 per share, the net profit here would actually be a loss of $50 because you have $50 in profit, but you paid $100 in premium per contract. Since each option contract is 100 shares, that means that this would be a net loss of $5,000. So buying put options can actually be really expensive and you can lose quite a lot of money. So you want to be very careful to have proper position sizing and risk management in place, which I will talk about very shortly in this video. Actually, let's talk about it now. Now that we've learned how to buy put options, well, you can just start buying them, right? But, you know, it's really not that simple. As you saw in the scenarios, you can not only make a lot of money, but you can also lose a lot of money. So you want to be very careful about how you go about buying options. With a put option, it's just like a call option. If it doesn't reach your strike, you lose the amount of money that you pay for the option. The good news is that, again, you can't lose more money than you pay for it, and you can recoup some of your loss or some of that premium if it goes slightly or partially in the money. So you can make varying amounts. That's where actually risk management comes into place. That's where taking profit comes into play. You may not want to hold the option until expiration. Oftentimes when a stock moves towards my direction, towards an option that I'm buying, I will almost always typically pick an exit point. So for me, an exit point may be when I have a 50% gain, when I have a 75% gain, or maybe even when I have doubled my money. So let's say that I spend $1 on an option contract, so $1 on a buy put. If that put option now becomes worth $2 in a short amount of time, now a short amount of time just depends on the total amount of time. So for example, if I'm trading a 1 week option, then a short amount of time might be a day or two. But if I'm buying an option for 6 months out, a short amount of time may be 1 month. So a short amount of time is really relative to the holding period in general. So this is really important because this is how you risk manage. This is how you take profits properly. Is for option buying, you almost always want to close this position and have an exit plan as soon as you have an entry plan. So it's really important to understand, hey, I want to enter at this price. Okay, so you want to buy a Apple 170 put. You think Apple's going to go down, that's good. But if Apple goes down to 170, as we saw in our scenario, we may not have a profit because there's still a lot of premium at expiration. However, before expiration, if it's only 1 week in and there's still 3 more weeks left, that's a really good move. And if it goes into 170, you're not really in the money yet, you're at the money. You can even be a little bit outside of the money on a long put option. You can be at 170 and 50 cents, which is 50 cents out of the money. However, this put option might already have a gain. If the put option already has a gain of 50% or even more than that, you may discuss with yourself and say, hey, self, I think this is a good time for me to take profits. I'm very happy with the return that I have so far. And in this case, I would say that that's fine to take your profits. You can take profits early and often. There's never anything wrong with that. So I do want to dive into some techniques that can help you limit potential losses, as well as looking at a stop loss or a stop limit order. All right, so we're gonna jump into my Robinhood right now, and I'm gonna show you an example of how I would run a buy put on Starbucks, okay? So I'm gonna go to trade options, and what I'm gonna do right now is I'm gonna pick a put option for the future. So let's say that I'm gonna just go out for something like July 19. Let's say that I think Starbucks is gonna fall further for whatever reason. Let's say that I think that people are gonna drink less coffee. I think that the balance sheet isn't looking good. They have a lot of debt. Whatever the case is, you wanna find a stock that you are bearish on. It's also really good to find stocks that have bearish momentum on the downside. So talking about technical analysis, which, you know, we'll get into a little bit later. All right, so let's go to buy put. So we're gonna go buy put, and then I am gonna pick something like the 70, okay? So if I click right here, you will see that I have a highlighted and the premium is $1.44. So I have to pay $144 to hedge 100 shares of Starbucks. Now remember, when you're buying put options, you can either make money on the option itself, or you can also hedge your portfolio if you already have Starbucks stock. Let's just take scenario number 1, because in almost all cases, you're just buying to speculate. You're buying to make money. You're not buying to really hedge your portfolio, although you can use this, and I do have some training on this, but let's just focus on scenario number 1. You're buying a put option to basically make money on the option itself, okay? So if I go right here, you can see here how at the top right, I have a few different things. I have a limit, I have a stop limit, and basically that's it for this position. So what I can do with a stop limit right here is I can trigger a limit order if the bid price rises to the stop price. So if I click right here, you can see here now that I can set a specific stop price. Okay, so in this example, I can go in and I can type in, let's say 1.42, and then for the stop price, I can say, hey, I want to be stopped out at X price. Now, I'll be completely honest with you, stop prices and just in general, let me go to another limit order. So you can also do a limit, so you can buy order at a maximum price or lower. So you can say, hey, let's say it's at 140, I want to buy it at 130. I don't want to pay more than 130. In that case, when you set a limit, you actually won't get executed on this trade at all until it reaches that 130. So you can say to yourself, well, I'm only willing to pay X amount of dollars. You can set a limit order. You can also set a stop limit, basically saying that, hey, I made X amount of profit. I want to stop here. And Robinhood or any brokerage can trigger a specific order to actually get executed at a different time based on a price that you pick. Now, I'll be honest, I don't typically do this, and you can do good for a day. You can do good till cancel. You can basically have these orders automatically making money for you. Say that you're at work, you're busy. You can say, hey, I want to get in at this price. I want to get out at that price. So you can set predetermined prices for yourself in the future. However, I will say that my typical risk management strategy is to not necessarily use stop limits or stop loss orders, but more so limit my position sizing. So position sizing is the most important thing. You can have some losing trades if the position size is small, it doesn't really matter. And if the position size is really big, that can be the end of your portfolio. So you really do not want to do that. And you can take an example like losing weight. You can have a little cheat meal here and there. You can have a cookie, a snack. But if you end up going on a binge eat and you eat a whole cake worth 10,000 calories, that's going to set you back. The same thing with trading. If you end up making one bad trade, it can set you back quite a lot. So you want to make sure that you have proper position sizing, which for me can be anywhere from 1 or 2% of your portfolio for option buying. Now, when you're option selling, it's a whole different game. I have lots of videos on this YouTube channel talking about option selling, which is primarily what I do to make currently around $80,000 per month selling options. So that's what I do. But when it comes to buying options, you want to be a lot more conservative, a lot more safe. When buying a put option, you honestly want to have a small position size, like I said, but you also want to really limit it to 1, 2, or 3 contracts. Or if you want to protect the position that you already have, a put option can perfectly get you out of a position you already own, because you get to pick a strike price and basically exit a stock at that strike price, however many shares you have. So if you have 200 shares, you can buy 2 contracts. Again, this gets a little bit more complicated, and that goes into the hedging territory of using put options. You can simply just make money by buying a put option and selling a put option as it makes money. Selling puts is by far one of the best, safest, and most consistent strategies to make weekly income in option trading. This step-by-step guide will help you better than any other video, and I'm going to be showing you proof. If you know the right time to sell puts, you can collect a ton of money from premiums with very little risk. So first, I'm going to explain to you very simply how selling put options works. Then we're going to get into the stocks and indicators that I look for when I'm about to sell some put options. And lastly, to show you real life proof trading so you can get examples and see how I do it in my own portfolio, I'm going to be doing some live trading and collecting income, and you'll be very surprised how much money I can make in just 20 minutes. I'm going to be selling puts live. I'm going to see if I can make $5,000 or ideally even more than that in this video. Let's keep track on the bottom right somewhere here, and let's get educated on consistently making money option trading. So get ready and let's flood your pockets with some money. Firstly, there are 2 reasons why you're going to want to sell put option contracts. 1, to generate income, and 2, to buy shares of a stock at a cheaper price than you can normally get them on the market. Imagine that a stock is trading for $165. You can buy that stock cheaper than the current price of the market. My ebook talks about selling puts in detail, and I'm going to give you the #1 secret to this strategy, which is actually my #1 strategy. A put option is simply a contract between the buyer and the seller. The buyer of the put option will have the option to sell 100 shares of stock to you as a seller at the strike price. And of course, you can pick any strike price you want to potentially buy the stock at that strike price if you do get assigned. So keep in mind that you want to be comfortable with buying 100 shares per option contract of a stock that you get to choose. You are in full control, but you must make sure that you do like the stock, because if you get assigned, you will own 100 shares. So selling puts can be expensive because this is one of the strategies where you do need to have 100 shares of capital ready to go. So if you have a small portfolio, you will have to stick to cheaper stocks such as HIMS, Palantir, NEO, under $5 of course, American Airlines, and well, other stocks that meet your portfolio size so you have proper position sizing and you don't hinder your risk management. And the best part about this strategy is that you'll get paid to sell the option to the buyer. At worst, you will buy the shares for cheaper, and either way, your cash will grow in your account. Remember, the buyer has to pay you a premium to have the option to sell shares to you at that strike price. The option buyer is paying to have that right. Here's an analogy to help you out. Puts are basically like you're an insurance company. You are charging a premium for the risk of the stock falling down and you having to buy that stock at that strike price. You are becoming a mini insurance company that can print your own money in the form of premium that you are collecting. The way it works is you collect a bunch of money up front when you sell a put option, and some of the trades you will lose. Again, we can't be perfect here. I'm not perfect. I make mistakes all the time. And just in trading, if you have a high win ratio, you win more trades than you lose, you will come out profitable. So in this example, what you want to do with this strategy is you will be collecting money up front. Some of the trades you will lose, but your winners will far exceed your losers if you follow my step-by-step instructions, as well as learn from the live trading that I'm going to do shortly. So let's use some real numbers to help you understand. Microsoft is currently trading at $410 per share right now. Let's say that you think Microsoft is at a low right now and you don't think it's going to go much lower in the next 30 days. So what you want to do is you want to sell a put option contract on it. You pick the strike of $405, which means if Microsoft does happen to fall below 405, you have to be comfortable to buy 100 shares at that price. But you won't mind that because you think Microsoft is going to be going up. You love Microsoft long term. You think that it's at a pretty good low, so you will be happy to buy it at 405. It's currently at 410, so you're going to get paid to buy it for $5 cheaper than where the market is at right now. Seems pretty much like crazy, right? Like, why would someone do this? Well, someone else out there in the world thinks that the stock might go down a lot lower. They may be right or they may be wrong. Either way, you are happy making this strategy in this trade. And let's open up Robinhood and see what I would actually get paid if I decided to sell the put option. So let's pick a strike price of 405. All right, so I'm gonna go to trade options as I usually do, trade options, and then I will go for something very short term. So I'm gonna go very short term here. We'll go actually to, we'll give it a little bit of time. So let's just go to the end of the month, which is just a couple of weeks. So if I go to the 405 right here, you will see that the premium collected is $4.80 or $480. So right here, I can actually make a 1% return. Now, I know this is 1% because I'm putting up 405 and then 1% of 405 is gonna be about $4.05. So there's actually over 1% return. I'm getting paid over 1% in under 30 days to buy a stock that is going to be a very good buy at 405. In fact, this is actually under 30 days. If I were to go to about 30 days, I would be a lot closer to actually almost 2%. So you can see right here that it's actually $7.05. So if I were to execute this option, one contract here would give me about $705. Actually, you will see here that I was actually on buy a put option, but I need to be on sell. So actually the price will be a little bit different. It's gonna be $615, which is still amazing. I noticed that because I saw there was a max profit and that was a bit weird. And this strategy actually has a max loss. Although the max loss here will look extremely scary, you might be thinking just, oh my goodness, why would you ever collect $615 with the max loss of 39,000? This max loss is actually, it's not really correct. In theory, it is correct, but what it means is if Microsoft went down to zero, you would lose $39,000. I don't know about you, but Microsoft is not going to go down to zero. I think the world has to literally end for the stock to fall that much. There is no way a company the size of Microsoft will go bankrupt. There's actually almost no way the stock will even fall 50%. Yet alone, in most years, it doesn't even fall 10%, or it doesn't even fall at all. The stock is rising, right? So although the max loss is very scary, this is the equivalent of you getting into your car and the max loss says, well, you may not live today. So, yes, that's scary, but most people still have to drive to work. We still have life to live, and we still take that very, very small risk to go into a car every single day. It's the same thing here. So it has a very big max loss, but in all reality, this is a very, very safe trade that I've been doing for the past 10 years. I've worked for Goldman Sachs as well as a couple other hedge funds. I have a degree in this. I've sat with many experts on this. I've talked to many financial advisors. I've talked to hedge fund managers. This is a very standard, easy strategy that basically every single person in the world does. I've seen billionaire portfolios as well. This is just a typical strategy that they are using. So basically, let's do some scenario analysis. If Microsoft goes up to say 420, you're totally safe. You're going to be making money. If Microsoft goes up to anything, really, if it goes up at all, you're going to be making money. If Microsoft actually goes down a little bit towards 405, you're still actually going to make money as long as Microsoft stays above 4. Now, at 405, if Microsoft were to hit 405, you would now be in assignment territory, meaning that you will get assigned at expiration if it's in the money. However, you still made a gain because you are collecting $6.15 here, okay? So we have 6.15. So really, if it's at 405, you're good. If it's at 404, you lose $1, but you still collected 6.15, so you are still positive 5.15. In fact, your break even here would have to go 405 minus the premium that you collect. So the break even here would be 399, or actually 398.85. I'm doing the math in my head. So at 398.85, that's your break even point, okay? You will be buying Microsoft at 405 or below, but at 398.85, that's actually your break even. So if it goes lower than that, you will be at a slight loss, even considering the premium that you collected, which is totally okay because you may deem to yourself that I want to buy Microsoft. I'm very happy. And by the way, this is the truth. This is not just an example. This is exactly a trade that I would make. And as you'll see shortly, I will make trades that look very similar to this. So, if Microsoft goes down past 405, you'll have to buy 100 shares of Microsoft, but it's not even that bad because you want to own the stock anyways. But how do you know if a stock is not going to go down? And that's by using some simple things called technical analysis. Technical analysis can make or break your trading success. It can make you either very profitable or it can make you a loser in option trading or any type of trading really. So technical analysis is simply just analyzing the price movement of a stock using multiple tools that I'm about to cover and show you real examples of. So many great option traders, I've worked with many of them, have used technical analysis to a great extent, including myself. I use technical analysis to accurately predict where the stock price of a stock is going to go. Now, this isn't perfect. Nobody really knows where a stock is going. In fact, there's a famous book out there called Random Walk Down Wall Street, which discusses stocks being completely random and not having any clear direction where they're going. Now, that book is not completely correct, but it's also not completely correct to understand or to say, I know exactly where the stock is going to go. That's a complete lie, and almost nobody can do that. So I'm somewhere in between. I think that technical analysis is very, very helpful. It gives you a very good sense of where a stock is trading at and where a stock is likely to be in the future. Now, short-term trading is very difficult, which is why I personally prefer monthly income strategies, but I'm going to show you all the strategies that I know around technical analysis. And I've said this many times on my channel before, my favorite 3 technical analysis tools are RSI, moving average, and Bollinger Band. The first one that I'm going to teach you is called moving average. All right, so now we're going to be looking at Amazon stock. I'm going to be using Amazon to give you some technical analysis. The first thing that I'm going to do is I'm going to go to the charting feature on Yahoo Finance. Yahoo Finance is free and I absolutely love it. So I'm going to get rid of currently what I have going on here, and we're just going to analyze the stock looking at it without anything, without RSI, without Bollinger Band, without moving average. I'm also going to clear up the drawings just to give yourself some understanding of where the direction is headed. So if I look at the 6-month chart right here, starting off with actually some lines, you will see that the hardest bottom here, the hardest low of the 6 months is right here at around $144. So if I click right here, you can see that that trend has actually been very consistent with going up. Now, typically I like to go for another bottom. So you can see here that this was another strong bottom. You see there's very good, strong momentum. Okay, momentum is really important because when I was working on Wall Street, one of the analysts that I worked with, which was a quantitative finance expert, he was looking at mathematical models. He simply told me that momentum is one of the strongest factors. And if you look at a 6-month chart, if the stock is moving up, it's likely to continue moving up. It's crazy how simple investing is when you really think about it, but that predictor right there, the 6-month chart, was actually explaining 80% of his returns. So basically this one indicator right here will give you 80% of the potential returns that you can get from all indicators out there. And once I teach you the rest of the indicators, you're gonna be in a really good position. So right here, you will see that you can go from a bottom to another hard bottom here. Like there's a big bounce here at the 155 level, or you can even go longer term and go for another hard bounce here, which happened at 173. So you can see how Amazon is in a very strong trajectory going up, and that's why right here this would have been a very good indicator to buy the stock, because we had a double bottom here. Okay, this was a very good indicator. You can see there's a double bottom, bottom and bottom, and this is basically a flat. This is basically flat right here. Okay, so Amazon tried to go down, jump back up, tried to go down, couldn't, jump back up. That was a sign to buy. Okay, even though this was a tough time, if you had bought at 180 for a little bit, it has proven to be a very good entry signal. Okay, so I would have probably bought right here, because as this was bouncing up, I would have bought somewhere in between, somewhere maybe around 175 area. I would have had a signal to buy. Now I'll show you the other indicators I would look at, but this would be a really good purchase based on this. This is actually a triple bottom pattern. Now, this is some simple line charting that you can use to understand where a stock is heading. The next one that I like to personally use is I like to go to indicators, and the most simple one is moving average. Now, you can use different moving averages. You can go for a 30-day moving average, you can go for a 60-day moving average, you can go for a 90-day moving average. I actually really like to use Yahoo Finance default. The reason for this is because the most common default is 50 on Yahoo Finance. That's what a lot of other investors are using since so many people are using Yahoo Finance. So I like to keep it at 50 days. It gives me a really good understanding of where the stock is. So if I go to clear the drawings, you will see that this purple line right here is giving me the average 50-day price. So in the past 50 days on average, where has Amazon been trading? You can see here how it's consistently moving up, and that's because Amazon as a stock is consistently moving up. And as long as it's staying above the moving average, this tells me two things. If the momentum is strong, I want to be in this trade. I want to ride momentum. I want to go with the wave, okay? I want to move with the motion. It's much easier. You probably heard this quote before, but a rising tide raises all boats, okay? It's really easy, or it's just how it works. When the tide goes up, the boats go up, okay? That's what you want to do when it comes to stock market investing. When the market is trending upwards, it's a bullish market, you want to ride that bullish momentum and make money. And that's actually where I prefer buying call options. Now, if it goes below the moving average, this is really interesting because this can tell you that momentum has shifted. But although momentum has shifted, there was two hard stops right here. So this should tell you actually Amazon is going for a good value because historically it is above. In the past 50 days, it's above this price, and now we're currently below, so 173 would have been a fantastic entry point. If I zoom out right here, you can see that basically Amazon has been completely trending up. So we're gonna go over a different example when it comes to technical analysis, but I wanna show you a couple more of the tools that I use, okay? Next one I use is going to be a RSI, okay? This right here I'm gonna use for 14 days. This is the Relative Strength Index. This is basically telling you based on volume, based on how much people are buying up this stock, where is the stock on an overbought or oversold basis, okay? At 20, this would be oversold. At 80, this would be overbought. We're currently sitting at 61. 50 would be very neutral. 61 means that this stock is heating up a little bit. It's heating up. There's a lot of people buying it. Maybe it's becoming less of a good value stock to buy right now. Before I go into Bollinger Band, I do want to look at a different scenario. So I'm going to look at a stock like a Tesla because Tesla has had some volatility and I have actually bought it very recently. So you can see here how Tesla is actually now consistently below the moving average. If I go to, let's go to 3 months here. Tesla is below the moving average. Here it had a really sharp decline. And here you can actually see on the RSI, it actually became very low. It almost hit 20, it almost hit oversold. But you can see here how it was 24. And because it was so low, this was a fantastic time to get into the stock because low RSI says that the stock is oversold. Too many people are negative. There's too much skepticism out there. This is a fantastic time to do the opposite, to be a conservative investor, to go against the grain and to make a decision to buy. So this right here at 140 was actually a price that I didn't get it at 140, but I started buying it at 150. I had 150 sell puts, by the way. So you already know right now what a sell put is. So I've sold puts at 150, and that's because I wanted to buy Tesla for $150. So now I'm actually very happy because I got assigned for 150 and currently the stock is at 184. So I ended up making really good money, like 20% return in like a month. So it was actually a phenomenal decision to sell puts. So yeah, so what I would look at right here is we're below the moving average. And now Tesla has popped up above the moving average. So now we have strong momentum. I would still jump into this stock right now. And I would use some option strategies. And I would use a bull call spread, which we will talk about later in this course. Because when it comes to buying options, there's some really interesting strategies that you can use. We can put up a very small amount of money and get a very big return. So I would use some different spread strategies on Tesla. Actually, how I was able to go 1 year from $100,000 to $700,000 back in 2021 was I was using a lot of spreads and a lot of small account strategies, which you will learn about on Tesla. I saw there was a lot of momentum. I traded Tesla very heavily and I made 100K into $700,000. I made $600,000 that year. It was a fantastic year, and it was a lot of Tesla trading as well as other technology companies as well. So with that being said, you now understand the simple use of RSI. You understand that towards 20 is a good time to buy. Towards 80 is a good time to sell. You understand that moving average just gives you a general idea of where the stock has been in the past 50 days. By the way, you can also change moving average from 50 days. You can change it to 90 days. So for example, I can click 90 and you will see here how this is a much more smooth line because now it's taking a 90-day average instead of a 50-day average. The next thing that I want to talk about is the Bollinger Band. So if I go to indicators and I go to Bollinger Band, you will want a period of 20 days, which means that Bollinger Band is going to predict the next 20 days. And the standard deviation is 2, okay? You'll see here 2 is fine, okay? So how this works is, this is a statistical model. It's very simple, okay? So if I click save, you will see here that we have an idea of where the Bollinger Band, where Tesla will trade, within what range, okay? You can see that the top of the band is going to be 196. The bottom of the band is going to be 139. 2 standard deviations means about 95% of the data. 1 standard deviation would be 68%. 2 standard deviations is 95%. 3 standard deviations would be 99%. It's a bell curve, okay? The way I explain this is if you are a man, you are 5'10", and you have a son, your son will be about 5'10". That would be the middle. That would be the average. Your son would be about your height, okay? That would be very high certainty. Okay. Now, if your son was 6 foot tall and you're 5'10", that would be towards this area. You would have maybe 1 standard deviation move. If your son was 6'3", this would be a 2 standard deviation move. And for your son to be 6'5", this would get into the territory of over three standard deviations above normal. So it'd be very unlikely, although possible, extremely unlikely that your son is going to be a lot taller given your genetics, okay? So bell curves are done with weight, with a lot of physics, a lot of statistics, height, nutrition, a lot of different areas use bell curve. It's just a very easy statistics, okay? So that's what this means. So if I go to Bollinger Band right here and I change this to 1, you will notice that this got a lot smaller, okay? Because now we have some unusual movement because this is a little bit less usual than a 1 standard deviation move. Now, if I do a 3 standard deviation move, which gets into really rare territory, okay, you will see how now the Bollinger Band has expanded. It has expanded to 210 on the upside and then 124 on the downside. I stick to 2 standard deviations because that captures 95% of the data. It gives me 95% certainty that an option will be in that price range, okay? So if I go back to 2, now I'm going to show you how I pick strike prices when I trade options. So if I click 2, you'll see here that if I were to do a covered call, I would sell a call option at 196. If I were to sell some puts, I'd probably want to go down a lot lower. Now, obviously, I can't go down to 139 here in the Bollinger Band because that would be just too low. There's no premium there. That's too far out of the money. But I would certainly want to go at 167. I would pick 167 to pick the middle of the Bollinger Band. So use the Bollinger Band to understand the different scenarios where a stock can go, whether it's up or down, and then pick the appropriate option strategy based on the Bollinger Band. So for me, I like to keep it as simple as possible because, you know, I am working with a lot of beginners and I focus on helping beginners get into an intermediate or advanced option trader territory where they can leave their 9-to-5 job and actually do this for a living and have a lot of flexibility in their life like I have. All right, so now I'm going to teach you some metrics that you need to pay attention to when looking at what option contracts to buy or sell. All of these things that I'm about to teach you are going to be extremely useful when you're analyzing how safe an option is. The first thing that I want to talk about is called implied volatility. Implied volatility is usually expressed as an annual percentage, and what percentage reflects the magnitude of how much a stock is expected to change in either direction for that given year, up or down. And people get confused over this term because it can look confusing, but it's actually very simple. We know that volatility means how much a stock price moves up and down. If it moves up and down a lot, that means that it has high implied volatility. If it doesn't move a lot, then it has low implied volatility. So ask yourself, do you think Coke has high or low implied volatility? Well, the answer is Coca-Cola has low volatility. If you look at something like a GameStop or AMC, when things were going crazy and parabolic during those times, those were high volatility stocks. Implied volatility just refers to how volatile we expect a specific stock to be, and to measure that, every stock is assigned an implied volatility percentage. This can get really overcomplicated, and all you really need to know is that anything above 50 is a high implied volatility, generally speaking, and anything close to 100 100 is extremely high implied volatility, meaning the stock is expected to shoot up or down a lot. Typically, stocks with extremely high volatility, these may be biotechnology companies that have some big events coming. This may be really hype meme stocks that have some news coming. This might be stocks that have had a short squeeze of some sort. So for example, if you remember what happened to GameStop back in 2021, it had a really high implied volatility right before the stock skyrocketed, and then it plummeted back down. So how does this apply to option trading? Well, stocks with higher implied volatility are going to have higher premium. So even if there are two different stocks at the same exact price, the premiums on them could be very, very different. And if one is expected to be more volatile, the premium on the more volatile stock will have more premium. Implied volatility is also very interesting because when you're screening for stocks and you're looking for good stocks to buy. So for example, I do use a software called OptionsFi. When I'm using a software like OptionsFi, they're screening for high implied volatility stocks. The reason why I like high implied volatility stocks is because I'm typically an option seller. So when I'm looking to sell options, I do want higher premiums. If I'm looking to buy options, then I want lower premiums. The next thing I want to talk about is the Greeks. So the Greeks are very important. It sounds a little bit confusing, but the Greeks basically explain how an option behaves, okay? So if you have no strategy when going into an option trade, or you do very little analysis and wonder to yourself, well, how would I lose money here? What if the stock goes up by $1? How much will the option change? The Greeks actually explain this. So the Greeks in option trading consist of really 5 of them. You don't need to know all 5. I'm going to go over them very briefly, but the first one is the most important one, which is delta. Okay, so delta actually explains a couple of things. Okay, first of all, if you look at delta, it explains the chances the option will be in the money. So if you look at an at the money option, let's say a stock is at 100, you look at a $100 covered call or a $100 put, it's going to be 50 delta because there's a 50-50 chance that the stock is going to be about the same price as it is right now. If you go for an out of the money option, okay, it's always going to have lower delta because it's lower chance than 50%. So it's going to have a lower delta. We use the 5 Greeks basically to help measure and predict the price movement of an option premium. Now, as I screen record my phone really quickly, you can see on Robinhood that we're going to look at some of these Greeks and we're going to go over them and what they mean and how to actually use them. Okay, so I'm looking at Microsoft sell put 415 for June 14th, the previous example that we were looking at earlier in this course. So you will see here that the delta is 0.48. That means that this option has a 48% chance of expiring in the money. Now, delta also means that if the stock moves by $1, this option will move by 48 cents. So that's exactly what it means. There's 2 definitions for delta. Those are the 2, okay? Gamma just changes delta, okay? You know, it's not as important as delta because you can see here how the gamma is really small. Theta is kind of important. Theta tells you how much this option is decaying per day. So you can see here that it says 0.1177. This means that this option is losing about $11 per day in value. If you're an option seller, that's a good thing. If you're an option buyer, well, that's not really a good thing. Vega also, it is somewhat important, but honestly, it's not that important because Vega just measures volatility. So if volatility changes, then the option will change by, 0.53 cents if it moves up in implied volatility by 1%. But typically implied volatility is changing, but not by too much. Although Vega is more important than Gamma, it's not necessarily more important than Theta. They're about the same. Rho is interest rates, which are completely useless because interest rates are not changing by much at all. So if I were you and you want to look at the Greeks, just simply focus on delta. So delta is the most important one. Delta measures how much the premium price of an option will change for every dollar the underlying stock price moves. So for a call option, this can be anywhere from 0 to 1. And for a put option, this can be anywhere from 0 to -1. Again, not a big deal. Basically, think about it as if it moves up by $1, then your option will move up by 50 cents towards the direction of the option. So if an option costs $3 and has a delta of 0.5, well, if the stock moves up by $1, then this option will increase by 50 cents. So it'll be from $3 to now $3.50. If it moves up by another $1, then this will again move up by 50 cents. Now, like I said, theta is really interesting because when you're an option seller, you can actually take your theta and see how much money you're making per day. So let's say that your theta is 10. Well, then you're making $10 per day on that option contract being open. So if you have many option contracts, you have 10 contracts, and then your theta is 10, then you can make $100 per day consistently just through theta, as long as the stock doesn't have any crazy moves. And that's exactly how I trade options is I have a bunch of positions open. I have maybe 20 positions. Each of them might, have a theta of 30 to 50, and voila, making well into the 5 figures or the multiple 5 figures per month in option premium. When options are closer to the money, they tend to have much more more higher rates of theta decay because they're right at the edge of either being valuable or being completely worthless, depending on the stock's price, the strike price. So, when options are close to the money, the theta is going to be higher, which is kind of fun and kind of cool, but also more dangerous because the delta will be higher. And when the delta is higher, that means there's a higher chance of you getting assigned, whether it's selling a put option, it's closer to the money, or a covered call, it also is closer to the money. So with that being said, let's just get into some real examples and let's show you exactly how I'm going to make some money in this video.
All right, so now is the part where we see how much money I can make by selling options. We're going to keep track of it on the bottom right or the bottom left. As I make every trade, we're going to be adding this up. So let's see exactly how much money I can make in the next 10 or so minutes, all right? So the first thing that I want to do is I want to look at Google. Google is one of my favorite stocks. I'm very bullish on Google. Now, in the past 3 months, the stock did go up about 15%. I am going to be looking at technical analysis as well. I'm going to be showing you what I'm looking for technically when I am placing a trade, like at what strike do I pick it, why, and all of that whole process. So this is going to be like the most valuable thing that you can see because I've been doing this for 10 years. That's exactly how I make my decisions. So if I go to Google, I go to charts. You can see right here, I'm going to get rid of these quick lines. These were drawn. So if you can see right here, actually, the stock has gone up. I'm using something called the Bollinger Band as well as the moving average. Both of these are very important for me, and I like to look at the 6-month view. So here you can see that Google is basically at the more higher end of its range. It did have an overreaction here and had a pullback. However, you can see that the Bollinger Band right at the middle is 161. Now, the RSI is not very high, but it's also not very low. It's at 63, which is a little bit higher than average. So this is actually a perfect candidate for selling a put option. Not that it's perfect for selling a put option because it's a little bit higher, but it's perfect because I don't know when Google's going to pull back. And if I want to invest in Google today, selling a put option is much better because I'm getting a cheaper price than what the stock is at currently. The stock's at 168 as I'm making this video. I'm going to sell a put option that is going to be towards the middle of the Bollinger Band of 161, 162. So I'm just going to go for 162.5. Now, I am going to pick an expiration date that's going to go out at least 30 days. This strategy is a little bit more boring. It's a little bit more chill. It's a bit more relaxed of a strategy. The whole goal is just to collect some income, be hands off, and be very passive with it as well as safe. So I'm going to go for June 21. So it's going to be about 5-6 weeks from today. Making this video, I'm going to go to sell put, and I am going to sell a put option for the 162. So I don't want to be too heavy on my exposure. So I'm going to probably go for a contract size of about 5. So I'm going to risk quite a bit here, and I'm going to collect $1,500 here on this trade. I'm going to go for a bid price of 305. Now, I will be honest with you, I could put in 3.1. I can start playing around and waiting, but for time purposes, I want to be very efficient with this video. I want to respect your time. I'm just going to go for 305. But if you want to make some extra money, you can play around with the bid ask. I could have asked for 310, and I may have actually gotten filled for 310. So that's kind of up to you. So far we've made $1,525 so far by selling a put option on Google. Now, one of my other top plays is American Airlines. This is a much cheaper play, specifically because American Airlines is about $14 per share. Now, this is my top play in my Discord, but right now I'm a little bit upset because as I'm making this video, I'm literally like 2 hours too late because the stock is skyrocketing. I have shares, I have covered call, I have sold a put option, but it's a little bit frustrating to see the stock go up because basically when a stock goes up, the put option premium goes down. It becomes less valuable because, as the stock goes up, it's becoming further out of the money. So right now, what we're going to do is we're going to go a little bit riskier. I'm going to show you a little bit shorter term of a trade. I'm going to go for the 14.5. Again, my goal is to actually get assigned. I do want to get assigned. If I don't get assigned, that's fine. I collect income. If I do get assigned, that's also fine with me because I still get to collect the income, but now I have the shares and I can run something called the wheel strategy, which we will cover later on, or, check out my channel for the wheel strategy. This is a very powerful strategy. So I'm going to go for selling a put option right now. I'm going to go for, since this is very cheap, I'm going to go for 20 contracts here, okay? So I'm going to go for just $17 per contract. And this is hopefully going to get filled for me since I did go towards the bid price. There you go, I got filled, so I made $1. So we're going to add that to the bottom of how much money I have made. So that is the second trade, which is going to be American Airlines. By the way, the reason why I like American Airlines so much, I didn't show you the technical analysis. I've been literally trading this since I started my program back in 2021. So it's been 3 years since I've been running Discord, and I have been literally trading American Airlines since the very beginning. And it's because American Airlines has some of the most consistent returns. The stock doesn't actually move up or down a whole lot. So over the past 1 year, you can see how it actually started at 1402. Now it's at 1461. So over a whole year period, it has gone nowhere. It's still at exactly where it has been, which means that there's a lot of volatility, but really no direction. So when there's no direction, that makes a perfect candidate for selling options in general, because options love volatility. And when you're selling options, you hope that there isn't any big moves typically. So this is a very profitable strategy that I've been running from the very beginning. And the reason why is because right here, we're right in the middle of exactly what American Airlines has been historically valued at. So it's unlikely to get a whole lot cheaper. It's also unlikely to get a whole lot more expensive. So selling options on American Airlines is my top play right now. That's why I decided to just sell 20 contracts. Now I do have some more contracts actually in my portfolio. I have 35 contracts, 30 more contracts here. So keep in mind, I do already have some of this position. Now we have done Google, we have done American Airlines. I'm also going to go ahead and do Apple. Apple's having a little bit of an intraday move where Apple pulled back, and I really quickly want to sell some put options on Apple. Now I already have a pretty big position on Apple, but I'm going to sell some put options and show you that it is okay to have big positions on big, high quality companies, especially companies that you have a lot of belief in. For me, Apple is my top play. I was just listening to Warren Buffett have his discussion on Apple. They had a little bit of a cut. They had some sale at Berkshire Hathaway where they did get rid of $100 million worth of Apple, but he had stated that that's just because of rebalancing and other things that are very normal. He didn't actually lose his confidence in Apple. Now, what I'm going to do is on Apple, I'm going to go out for June 21. Actually, I can also go really short term. So again, if you're watching this in the future, just go for something short term, it's fine. You go for short term or longer term, you actually get compensated in proportion to the amount of time that there is till expiration. So whether you get paid $1,000 a week or $4,000 a month, it's basically give or take the same thing. So I'm going to go for a sell put. I'm going to go for the 177.5 strike price. My average cost right now is 182. Intraday, actually, Apple was above my average cost, and now it's a little bit below. 177.5 is perfectly reasonable for me because I'm actually going to be dollar cost averaging and getting a better price. I'm going to be reducing the price that I'm paying per share that I paid in the past. So for me, it's a good decision. I'm going to go ahead and sell 10 contracts right now. So I'm going to go for 10 contracts and I'm going to execute this for $1.12. So I'm going to collect $1,120 right now. And boom, we just got filled. So that's amazing right there. So we got filled for Apple. So we're going to add that to how much money we have made. Now, the next stock that I'm going to trade is going to be Amazon. I already have Amazon. It's actually above my current average cost by quite a lot. I'm up 37% on it. I do have some covered calls, and I would not mind having a little bit more Amazon. So I'm going to double down. This is something that I should have done a very long time ago, but I'm going to finally double down on Amazon, and I'm going to sell some put options. Now, if we take a look at Amazon technical analysis, this is going to be important. I've actually shied away from selling put options on Amazon because I was a little bit concerned that the stock was kind of hot. So indeed, I was kind of right. We had a pretty decent sized pullback. However, what I was wrong about was not that I'm good timing. No one's really good at timing the market. If anyone says they're good, they're completely lying. I didn't time this well. So I, kind of missed the boat at 175 and the stock's now back at 186. But what I can do is I can sell a put option closer to 180. So what I'm trying to do here is I'm not going to get 175. And I already know in my head right now, if I were to sell 175 options, they are completely worthless. They're worth, 30 cents. That's not that much. So what I'm trying to do right now is I'm trying to bridge the gap between where the stock is right now and 175. I'm not going to get to 175. I also don't want to buy it at 186. So I'm going to find the middle point. I'm going to go for 180. So this right here is not going to be a whole lot of money, but it's a pretty safe, consistent trade. And the worst that can happen is I get to buy more Amazon. I think this would be a pretty good price for Amazon anyway. So as you can see, this is a non-losing strategy. You really can't lose. I'm collecting some income. I just got filled, made $409.85. We'll just call it $410. The next stock that I'm going to trade, I actually had Snapchat at $9 and I was really, really bullish. And the stock actually did end up exploding up after earnings. Now it is a little bit high. So it's a little bit hard actually for me to sell put options because psychologically I have sold $9 puts. I mean, myself, my Discord, we made a lot of money. We made $1,650 by selling 50 contracts here. And now it feels really bad for me to sell a put option at 16, at 15. That's going to feel awful because I have sold a put option at 9. So now selling at 15, 16, I have to spend more than 50% from what I have, before sold some puts on. So this is psychologically very difficult. But at the same time, after this option expires, I really don't have a position anymore. So I don't really have that much of a choice besides selling some put options. I'm not going to sell that many, but I'm going to mix it in right now. And I'm going to sell some May 17. Actually, I can go for some really short. Yeah, we'll do a May 17. I'm going to go for the 16 strike. Now, why am I going 16? And why don't I need technical analysis on this play? Well, for me, I really don't have an option here. Check it out. I can go for 15. There's no money there. There's no money. Literally, it's $8. I can go for 15 and a half. It's a 1% return in 11 days. Not bad. But you know, Uncle Henry wants more money than that, more than 1% in 11 days. So I would like to go a little bit more aggressive here. And this is a small position. Now, I'm not going to put in 10% of my money. I'm not going to put in 5% of my money. I'm going to put in very small amount. I'm going to go very small here and start to potentially get into Snapchat. I don't know if I'll get into it or not, but if I do, I'll be pretty happy actually. And if I do get, assigned on these 20 contracts, I'm just going to go 20 more. I'm going to go 20 more, 20 more, and 20 more. So I'm going to go 3 times for a total investment of, quite a lot, but in relative proportion to my portfolio, it's going to be about 5% if I were to get assigned 3 times in a row on this type of size, okay? So I'm going to review this order, I'm going to submit it, and I'm going to collect, hopefully, yep, I got filled for $539.40. So this time we'll round it down, we'll say $539, so we'll add that to the amount of money that I have made so far. Now let's go to another stock where I can make some money. I do have Palantir. I am currently doing pretty well on Palantir, $13,000 on the stock. I'm down a little bit on the options. It's a little bit difficult for me to trade this right now. It's up 7%, so I don't think I want to sell puts, as well as they do have earnings as I'm making this video. So selling puts before earnings can be smart, but oftentimes there's a lot of volatility before earnings. So I typically don't like to sell options into earnings. I typically like to actually buy options. Buying options is better. We see American Airlines completely exploding up towards the upside now. That's interesting. So we'll see what happens there. Now, I do want to make another trade. I think that I would love to make a PayPal trade. I think that the stock is going for a really good valuation. However, I will say that I currently do already have a decent sized position of 9.69%. And for that reason, selling puts would not be smart because then I wouldn't have proper risk management. I would be way too invested in one stock, which would be very dangerous. So instead, what I'm going to do is I'm going to look for other stocks. So looking through my watch list, I'm going to take a look. And I could also easily do something pretty short term on QQQ. I don't always do this, but I can show you something kind of like a 0 DTE trade. A 0 DTE trade is something that's going to expire in the same day. This takes a lot more work. But, long story short, I would like to show you that you can sell puts really short term. SPY and QQQ both have expirations on the same day. Let's see exactly how much money we can make. So I'm going to go to sell put option, and I can scroll down to something that's slightly out of the money. I'm going to show you delta right now. So if I go to 437, you can see how the delta is 0.14. That's really good. That's a sweet spot. That means 14% of the time that this option will go into the money. That means about 86% of the time that is not. So this is going to be pretty safe. I'm going to go for this right here, and I'm going to click continue. Now, I'm not going to make this too big. I'm just going to go for 3 contracts. This is going to be an interesting trade. I just want to mix it up and show you all the ranges of possibility and give you as much education as possible. So on this trade right here, I'm actually collecting a very small amount of money, and I'm risking quite a lot of money, but it's also a very low probability trade that can go against me. It's also a very short-term trade of just 0 days. Okay, so we're going to add about $33 from that trade. Okay, now I want to look at something like potentially like a Starbucks. Starbucks did pull back quite a lot here, so this could be a good trade to make. I want to see what other stocks I may have here that I am very bullish on in the longer term, because right now I give you a very short-term trade. I want to go for a very long-term trade. So a longer-term trade would mean that I am very bullish in the long term. I'm actually pretty bullish on Chipotle. However, Chipotle, I do know on the top of my head, is a bit more expensive. So I can go for something that, I have actually traded Meta quite a bit, and Meta seems to have a really strong bounce here. You can actually see how I'm up about $1,000 on a sell put that I already have on Meta. So I can just go for that again. I can go for future expiration here. I'm going to go to sell puts. I'm going to go for something a little bit longer. So we have already showed you guys that I can go for a 0 DT trade. Now I'm going to go for an August trade. It's about 100 days out. It's not too bad at all. I'm going to go for about 100 days out, and I can go down to say 410. This is a 22 delta. It's a little high for me. You can go for a 405, 20 delta. It's about right. I think this is fine. Right here, check out the bid-ask spread. It's 1180, 12. By the way, the reason why I'm not always looking at technical analysis is because I'm following these stocks on a very regular basis. I'm very close with all my stocks on my watch list. So I'm paying attention to these stocks, and I know that Meta has really, really good support around 400. So you can see here how this is 405, but my break even is 393. So my break even is below the support line. So if it hits support, I'll actually get exercised. I'll actually have to buy shares of Meta, but I'll be pretty happy because I'm going to be buying shares below what is support. So I'm actually going to be owning shares and still be in a profit because 393, the average cost here is going to be a below what the stock will trade at. So if the stock goes down to 400, I'm going to get exercised, but my break even is 393, so I'm really not going to care. Okay, I'm going to be in a positive. So I'm going to go ahead and sell the 405 here, and I'm going to go for a probably decent sized position. I'm going to go for 5 contracts, and I will go ahead and execute for 1180. And just if you guys weren't sure, I wasn't sure how much money I have made. I don't see it on the screen at the moment, but yeah, this trade itself is going to bring in $5,800. So I think I'm going to pass the trading challenge that we just had. So there you go. I submitted. So we're going to add $5,899.85 or $5,900 to our trading challenge here. And there you have it. We have made a grand total of this amount of money on screen right now by selling put options. Now, some of these puts didn't expire yet. Some of them will expire pretty soon.
But as a beginner put option seller, you might be thinking, well, those option premiums are nice, but how do I actually manage those options? How do I go about closing positions, taking profit? And now to make sure that I really don't lose money afterwards doing these strategies. And that's exactly what I'm going to cover in this part of the course. Managing your positions until expiration is extremely important because if the stock shoots way below the strike price you choose, it's not that ideal for you to get assigned and it may actually be scary. You want to manage that position, make sure that you're on the winning side of the trade. And if you're not on the winning side of the trade, how do you minimize the risk associated with owning and getting assigned 100 shares? And that really shouldn't be happening in the first place most of the time if you're picking the correct delta. If you're picking the correct Greeks. Also, as a beginner, you should be okay with the worst case scenario before you make a trade. Before you sell a put option, ask yourself, am I okay buying this stock however many, X shares? If it's one contract, am I okay buying 100 shares at the strike price? So if you're selling a 55 strike price, am I okay to own 100 shares at $55 per share? If the answer is no, then you shouldn't make the trade unless you really like risky trades and you're trading more as a speculator rather than an option trader that's looking for consistent income. And on top of that, you should be selling cash secured puts, which means you should already have the money set aside in your account that you'll need if you do get assigned. This is called being cash secured. So if you sell 55, you will need a $5,500 cash balance to potentially get assigned and buy those shares. So with all those factors, there shouldn't really be a losing situation for you when you're selling puts. You should be happy you get assigned or happy that you don't get assigned. However, I understand that sometimes the market can be very unpredictable and things do change and they don't always go as planned. So right after you collect premium, you need to keep a close eye on the stock. And just when you sell a put option, you need to understand, hey, is this really going against me? Is the momentum too strong here? Has something fundamentally changed about the stock? Maybe there's some news, or maybe there's an event in the market that changes your overall outlook on the stock. Remember, there are only 3 things that can happen when you're selling a put option. The stock can go up, that's perfectly good, you should be happy. In which case, you're good, you don't do anything, okay? The buyer can't exercise it, it's out of the money, it makes no sense for the buyer. It can stay at basically any level above the strike price and you are good. If it goes towards the strike price that you have sold, you may be a little bit worried. However, I will tell you, there is absolutely nothing to worry about before expiration if the stock is still out of the money from your strike price. I know a lot of people get anxious. They might be thinking to themselves, well, is this going against me? Should I cut this position? I would say that in most cases, you want to relax because even when I was working at Goldman Sachs, we did some studies and we saw that many options will actually dip into the money. And over 40% of the time, I think the statistic might be even higher than that, the option will come back out. So if it even dips into the money, you may not want to close. You may think about closing. You may decide to yourself that I may be looking to close potentially if it continues to go down, but that doesn't mean that you want to close just yet. It's totally okay for an option to go into the money and for you to hold that position. In fact, for me, I typically hold positions up until expiration, even if they do go into the money, because I've noticed that I get higher raw returns, which means that I get more returns, more money by holding until expiration. However, it is very difficult. So this is a mental game. This is a very emotional game that you have to be very aware of, that if it goes into the money, that's okay. Unless something has fundamentally changed or on the technical chart, as you will learn very soon, has completely shifted, then it's okay to continue holding. The only thing that you actually need to watch out for is if the stock starts to go down completely, breaks down, goes way into the money, and the RSI is still high. So if you want to look at the RSI, I look at the 14-day period. If it's still above 50 and the stock is coming down, that is one bad sign. As well as if it's going down, but it's still not at the bottom of the Bollinger Band, that's also a negative sign. So if it does go down, and let's say that the company that you are trading with is below your strike price, you just want to make sure that you have the cash available. So once you get assigned, then we will actually run a different strategy, which I have been teaching for a long time, called the wheel strategy, which we will also cover shortly. If you are just trading puts and you want to open and close them all the time, you will be losing money if the stock moves down. And yes, when you buy it back, if the stock price is now close to the strike price, it will cost you more money to buy it back. So you won't always be able to win by trading put options, but you will basically be almost always winning if you just sell puts and you wait until expiration. Even if the stock plummets, again, you're not going to be in a bad situation if that's already a good stock that you want. This is a way that you can minimize your losses when selling put options. You don't really want to close them, you just get assigned. But that's not it. After that, you can do what's called rolling options if you wish. You can actually roll a put option lower. Rolling the option in the case just means that you're buying your put option back and you're simultaneously entering a new option trade with a much better position or a much better strike. As you will see examples, I do this all the time. Sometimes it's for a net credit, and sometimes in the case of covered calls, I'm very happy to even roll for a net debit. Don't worry, rolling can be confusing, but once you see the examples, you'll see how easy it really is. So when you roll a position, just know that the new option trade will have a better strike price because you're going to be going down in the case of selling puts. In the case of doing covered calls, you will be going up. You're always going to go in the direction that is more favorable to you so you can make more money. In terms of expiration date, you will always have to go out. You'll always have to have more time because time will fix your position. Time gives you the ability to collect more premium and to fix things and to adjust things. So I've actually had a trade where I was down $31,000 on my portfolio, which isn't necessarily that much money in relative to how much money I have. However, the $31,000 was, pretty difficult for me, and I really wanted to recoup that loss. And what I did was when I rolled an option, I actually made back the $31,000 and $5,000 more within a single month by just rolling and adjusting a position. So this is one of the most powerful strategies, the most powerful techniques that you can have in your arsenal, in your portfolio, in your toolbox, if I'll say, of option trading. So you know the strategies, but then also this is a very important use of managing each and every single position. And you'll see different scenarios where sometimes you will want to decide for yourself. This is a very experienced game where psychologically you get to decide yourself what is better for you. Do you want to roll a position? Do you want to get assigned? How far do you want to roll? You don't have to follow the dog strategy of, 30 days out and down by 5. You may decide that you only want to go down by 1. You may decide that you want to go down a lot more by 10 in the case of selling puts. You may decide that you want to go 60 days or 90 days into the future. Now, not only have you basically minimized your losses by rolling or adjusting, but on your new position, you can actually make huge amounts of money by collecting more income when you are rolling. It sounds amazing in theory, right? But of course, I understand that you as a beginner will not always know what to look for when rolling your position. So to help you out, I'm going to show you an example of a sell put position that I will roll. And the key point is that I'm going to be making more money. I'm going to show you different scenarios of maybe I'm going to lose some money. I'm going to get a much favorable strike price. Maybe I'm just going to move the strike price by a little bit and get a good net credit and actually collect income. So let's go into some examples right now. I'm going to show you exactly how rolling works, how I think about rolling, how I think about adjusting. And the good news is, since I do this so often, I have many positions that I'm very positive that I'm going to be rolling right now. I'm going to show you some live examples. Alright, so here's my portfolio. I'm currently sitting at $2.1 million. I am frequently taking money out of this portfolio as I am making income. So, typically stays around $2 million because I use this portfolio to fund my lifestyle. Let's just go into some trades that I currently have. You can see here that I have a trade on American Airlines that has already made money. Now, there's no point of rolling a position if you've already made money. In most cases, if you're making money, I wait until expiration. Now, sometimes I will close the trade out early and I will take profit. That is a little bit complicated of a situation because when is it best to actually close a position? Well, in this case, as this option expires in just 3 days as I'm making this video, if an option is expiring in 3 days, then there's really no point of closing. It's just 3 more days to wait. You can see the option is up 94%. I have 5 more percent that I'm going to be making from the option premium the next 3 days. That's perfectly fine. Now, right here, if I actually change the view from total return to last price, you can see how it's 2 cents. Yeah, 2 cents is not that much. It's basically $2 a contract, but I have 35 contracts here. So if I were closing this trade right here, I would basically close and have to pay about $70. Now, for me, I'd rather just wait the 3 days, make the $70, not a big deal. I'm gonna wait, okay? Now, if this trade right here was expiring in 2 weeks and I had to pay $70 to close this trade, and then I had 2 more weeks of my capital that was freed up, this is quite a bit of capital, by the way, because it's 35 contracts of about $1,000 each. So if I can get $35,000 and I have to pay $70 to kind of clear up my capital, obviously I'm still making money here. It's still for a gain, because if I go to the total return, you can see how I'm still well above $1,000 in collected income. Then for me, that's going to be perfectly okay because I have 2 more weeks, but 3 more days, not so worth it. Okay, so that's how I think about when I can even close a position and take profit. And it depends on something called the annualized return. I go over annualized returns during my coaching sessions. If you're interested, it's just the first link in the description. Annualized returns can be really boring, so basically you can just do the simple math in your head and see if it makes sense for you based on how you feel. If you get enough days, like I said, 2 weeks, maybe that's enough time. Whereas, 3 days, there's no point of actually closing the trade. All right, so the next trade that I want to look at is going to be something like an Apple, which I'm also up on. So let's look at something where I am down on, because typically when I'm rolling, I'm looking for a trade that I'm not making money with, because the whole point of rolling in most cases is that basically you're trying to fix something. You're trying to compensate and make money back from a losing trade. However, I will say that you can also roll a winning trade to make more money. For example, let me actually go to a winning trade first. I'll show you what I mean by that. So if I look at this Apple put option, it's a 177.5 put option. I have sold some puts here. You can see here I've sold 10 contracts. And so far I'm up just a small amount, about $110. Actually, you can see my simulated return right here is that over time, this option will actually continue to gain money. So at expiration, I'm gonna just make over $1,000 if Apple stays at the 183 stock price. The reason why this is going to make money is if Apple stays at about $183, which is the current stock price, this 177 put option is going to be out of the money. However, if this starts to go back and it starts to go lower, you will see that the simulated returns are slightly changing. I still make my full amount at expiration because it's still out of the money, but in the meantime, I will have less returns. So as I go down, you can see how even in the short term, if Apple were to go down to 180, then this option right here would be in the red currently. However, it would still be in the green at expiration, again, because it's out of the money. And if I keep going down, you can see how this option will show a net loss. So when you make a trade, when you sell a put, you may have a net loss. You may look like this option is losing money. But the fact of the matter is, it's only losing money right now if you were to close the position. But if you wait, like I said, if you wait until expiration, you will still see a green profit. So although it can be scary when a stock is going down, it's really not an issue as long as the stock is still out of the money. Even in a more extreme case scenario right here, you'll see that I made the stock price 177.70. You will see that basically we're going to be in the red up until almost the last day of expiration, the last couple of days. Then this will start going into the green. Okay, now if this is actually below the price of 177.5, then yes, this sell put option will be losing money. However, again, this is not a problem. If you want to get assigned, you'll get assigned, you will have a small loss, but then you just start running the wheel strategy. So what would happen if Apple went down below 177 and you don't want to get assigned and you don't want to run the wheel strategy is you would roll the position. So we can go to roll this position, and although this won't be a perfect example because it's currently above, I'll show you what rolling looks like in this case scenario, how I can roll this position. So what I do is I clicked roll the position. Now I can pick a future date. So you can see how this option currently expires May 17. I have 10 buys to close, okay, because I'm going to be closing the current position that I have, right? Rolling is closing one position, opening up a new position. So I'm going to be closing this and I'm going to be opening something into the future. So let's go for June 21, all right? So this is about 30 days, okay? And now what I can do is I can get a more favorable price for myself. So although the 172.5 isn't available, so I can't roll this by 5, I can roll this down by 2.5. I can go down from 177.5 down to 175, improving my cost basis, improving my strike price, going down. In the case of a sell put, it's good to go down. You have less risk. So I'm moving down by 2.5. The time change here you can see is 35 days. So I'm increasing by 35 days, that's the time. I'm moving down by 2.5, okay? And actually I'm collecting a credit of $1.39. So I'm collecting $1,390. So rolling is really amazing because not only am I going down from 177 to 175, improving by $2.50, I'm collecting income to do this. And the only thing that I'm paying for this is by time. I'm not paying any money. I'm actually making money, but I'm paying with 35 days more of time. So this is a good example of how you can roll an already winning trade and make it more of a winner by moving down and by collecting income. Now, let's actually go to a losing trade, and I'm going to show you what a losing trade looks like in the case of selling a put option. So currently, I've sold some put options. I don't see any losers. Most of them are actually winning. So I actually don't have any current losers in my portfolio when it comes to selling put options. So I may have to show you another trade where it is a winning trade, but I'm going to roll for more profit. So what we can also do is I can show you how to roll a covered call, because I do have some covered calls that are losing. So currently don't have any sell puts that are losing. You know, it's a strategy that's working, as you can see, but we can go for a hypothetical example as well. Let's go down and use something like Palantir. So let's say that right here, Palantir is losing. Okay, so right here you can see it's winning, but you know, since I don't have any losing trades, let's just pretend that this is losing. So here's another example, and this is already expiring quite a bit out into the future. And by the way, I can actually show you my history. The reason why it's probably expiring in July is most likely that I have already rolled this. So whenever you see my expirations that are kind of far out into the future, that's typically because I've rolled. Okay, so I did not roll Palantir, but let me find a position that I did roll, because I do roll all the time. We will want to see this through an example. All right, so you can actually see here that I have had some difficulties with Apple with a negative $33,000 loss. Again, it's not really a loss because I've been rolling quite often. So let me just show you a covered call example, okay? This will be a covered call example since I don't have any sell puts that are actually losing right now. This is my biggest position right now, which is Apple. At the current time I'm making this video, I have two portfolios. In this portfolio, it's a lot of Apple. And I think there's nothing wrong with having low diversification once you get really good at option trading and you have a big bet that you want to make on a big safe stock like an Apple. It's really not an issue to put in more of your capital, especially if you're going to trade something like SPY, which is an index fund. So S&P 500, SPY is an ETF, as well as QQQ. QQQ is the NASDAQ ETF. It has a big basket of a lot of stocks. So for me, SPY and QQQ are two ETFs that you can put 100% of your money into and just trade those two things without even having to trade stocks. And option trading works the same way on those two. They're basically like stocks, but within those stocks, there's a lot of different companies inside of them. Okay, so Apple, we're gonna have to switch our mind a little bit, and with a covered call, you want the opposite to happen, okay? So when you're selling puts, you wanna go down, you wanna get a lower price, okay? Because, you know, like I showed you, if Apple was in the money, I would roll it down from 177 to 175. Now, in the case of a covered call, we actually wanna move up, because remember, a call, when you're buying a call, you're betting on a stock going up. When you're selling a covered call, you are making income on a stock that you own because it's covered. But if it goes above, right, it moves above, you will lose your shares. For me, I do not want to lose my shares of Apple. I'm actually making money on Apple. And if I were to lose my shares, I don't want to lose them for a couple of reasons. One of them is taxes. I do not want to pay taxes. Now, when I say I don't want to pay taxes, I mean legally. If I don't sell the stock, I don't have a gain. That means I don't have to pay taxes, okay? So that's really important for me because I am in a very high tax bracket. So what I want to do is I want to roll this position up, therefore I do not lose my shares and I don't get assigned on this position. So you can see that Apple is currently at 182.90, whereas my covered call is at 175. So what I'm going to do is I have a loss here. I'm going to click roll this position. Now, keep in mind, later on in this course, when I cover spreads, when I cover iron condors, when I cover other strategies, you cannot roll other strategies in Robinhood with one press of the button like I just did. You will have to close the position yourself manually and then open up a new position. Robinhood, though, gives you the ability to roll both selling puts and covered calls. These are the only two things that you can roll on this platform. Now, other platforms, which I'm not an expert on, do probably, I think many of them do let you roll in one transaction, even if it is a spread, because some of those platforms are paid platforms, whereas Robinhood is free. It's not necessarily free. There are some other issues, but that is a topic for a different video. So what I'm going to do right now is I'm going to show you how I can roll this option that's expiring on May 24th, okay? In just 2 weeks, I can roll this into the future. So I can go from, let's say, May 24th, I'm going to go to July 21st. So again, I'm running the dog strategy, the strategy that I basically came up with and called the dog strategy. I can move out by 30 days and by $5. So right here, you will notice that I can move from 175 to, for example, 180. Now this right here will cost a debit. So we're going to go over a couple examples right now. This right here is a debit. I still have to pay money. Why? Why do I still have to pay money? Well, in this scenario, I'm moving up by $5, which is actually a lot of money because I have 70 contracts. 5 times 70 times 100 shares. Each option contract is 100 shares. This is going to be $35,000. In 28 days, I'm going to improve by $35,000. And the total debit here I'm paying is $8,000. So I'm paying $8,000 to make $35,000. That's why in this example, it will be actually somewhat expensive to close out this position and roll it. It'll cost $8,000. However, if you don't want to pay at all, what you can do is if you increase the time. So if I go to 73 days away and now I pick a 180 covered call, you will see now due to time, due to the extra 30 days or so, now going from 1 month to 2 months, you will actually notice that I'm now collecting a net credit of $2,800. So I went from spending $8,000 to making $35,000 to now collecting $2,800 to make $35,000. That's how rolling works, and you can play around with different strike prices. So let's say that you want to move up by $10 because when I move up by 5, I'm still in the money. So if I wanted to move up by 10, my total debit would be very big, right? Because I'm moving up by a lot. So now my debit would be 16. Okay, if I wanted to roll up by a lot more, my total debit would be 46,000. Okay, it does not make sense. You want to make small adjustments. That's why when a stock does go parabolic, it moves up a lot, it falls down a lot, rolling is not your get out of jail free card. It's not going to get you out of every single situation. At the end of the day, if a stock moves against you completely, you will have to wait patiently to actually make your money back. You won't always be able to roll and fix every single position. However, I will say that rolling for me fixes 90% of positions. So as long as the market isn't crashing, as long as you're picking high quality companies, you're gonna make money rolling. And in this example with the covered call, I've already made money. It's already above my average cost and I've already collected income as a covered call. The only thing that I'm really paying for here, the debit, is to not lose my shares and to step up in my cost basis. And by the way, I advise, well, I'm not a financial advisor, of course. I'm just the guy on the internet, but I advise or tell my clients, my students in my Discord that they can roll unlimited times. Guys, you can roll indefinitely, month after month, after year, forever, for the rest of your life, without ever having to actually pay money for taxes. You can keep stepping up in your cost basis. This is actually one of my unlimited profit potential strategies that I use with rolling. I just roll indefinitely forever. All right, guys, so we've talked a little bit about technical analysis. We used my 3 main indicators, which is RSI, Bollinger Band, and moving average. Now what I want to talk about is fundamental analysis, okay? From one perspective, you can look at the charts and see where a stock is historically and where it is today. So you can see where the stock was trading at. So if a stock such as PayPal, which is a really good example, if I pull up PayPal, PayPal was a $300 stock. It has pulled back tremendously, and that is the reason why I bought the stock. So if I go to the chart right now, you can see here that in the past 5 years, this is a very interesting chart. The stock went up all the way to $308. If we take a look, this happened in 2021, and then since then, the stock has absolutely gotten decimated and has crashed down to just $66. Now, taking a look at the past 6 months, the stock has really not done a whole lot, which is really interesting. That means the stock was trading at very high levels, has pulled down tremendously. Now it's going sideways, which means that this is a very interesting stock for a selling strategy, such as a covered call. A sell put specifically would work very well here because it's very unlikely that PayPal is going to fall lower. For example, if you look at the Bollinger Band low is 61.
The Bollinger Band high is 68. So this stock is trading in a very specific range. So this sideways action is actually very good for covered calls, selling puts. It's also very good for an iron condor strategy, which we will talk about once we go over spreads. So this is very interesting from the perspective of technical analysis because you can understand where the stock was trading at and where it was trading at right now. Now that's a technical perspective. Now I want to talk about fundamentals, okay? So when you couple technical analysis as well as fundamental analysis together, you really get a good picture of the stock and you get to understand the company a lot better. So here's what I would do if you want to understand fundamental analysis. So I like to go into the statistics tab of Yahoo Finance. Now you can also use your broker. You just need this data. It doesn't really matter exactly what platform you use to understand this data. So first of all, the market cap here is $68 billion. That is a pretty big company, which is good for option trading. I don't recommend people trade options on companies that have lower than a $2 billion valuation. Typically, those options are very illiquid, meaning that there's not a lot of volume. And when there's low volume, that means that the bid and the ask spread, I can go over an example of this real quickly. The bid and the ask spread is going to be very wide, okay? Here's what I mean by that. A bid and ask is exactly what you're paying for or you're collecting in terms of when you're buying or selling options. So for example, if I go to trade PayPal options and I go to buy a call, and let's say that I just buy a 70 call here, you can see that the bid is 5 cents and the ask is 6 cents. That's amazing. That's very good. That means they're very, very close. And when you're trading, you don't really experience any slippage, no costs. You're getting a good fill rate. You're gonna get filled on this, right? And the volume is very high. Now, let me show you something where the volume would be really bad and the bid ask would be really bad. So if I go to like a different expiration day, let's say December 20, and then I pick something like 72.5, you can see right here that this is still actually a very good bid-ask spread just in general because PayPal is a very actively traded company and it has a good market cap. I'm going to show you in just a moment a bad example, but this is a little bit wider, but still really, really good. But if I go into a stock, let's say I go into, Oatly, or if I go into something else, like I could go into an expensive stock like Chipotle, but let's just go to Oatly. Okay, I haven't traded this stock in a very long time. Let's go to sell put and let's go to a future expiration day. Let's say we're going to go for January 17. All right, so if I were to go to the 0.5 here, this is an awful option. Like this is absolutely really, really, really bad. This is what I mean by a company that's smaller is going to have bad options. So the bid here is 0. Okay, so if you're trying to sell this, you'll literally probably get nothing for it. You won't even be able to get filled. And if you want to buy it, you have to buy it at 15, okay? So this is really bad, and also there's 0 volume. So literally nobody in the entire world has traded Oatly today. The volume is 0. The open interest is kind of high though. 944 contracts have been traded historically in the past, but you can see here how the bid and ask is just really, really bad. Now, if I go to Chipotle, this is a stock that I really like. However, it is very expensive, so I do look to trade spreads on it. However, I can't even really trade spreads on it, and I'll show you exactly why. Again, talking about the bid-ask spread, and this really important tip when you're trading options on market cap size, which has to do with fundamental analysis. So if I go into, let's say I want to sell a put, okay? If I were to sell a put, and this is very similar to selling a put credit spread, but let's just go for a put. Let's go for July. So if I were to go to, I don't know, even something like near the money, you can see here how the bid and the ask is so bad. Look, it's 73 and 79. That's a $6 gap. That's $600. So if you were to get filled for this, you're probably going to get filled somewhere in the middle. And that middle point is $300 away from the bid and $300 away from the ask, give or take. So you're literally losing $300. Now, granted, you are going to collect a good amount of money here. You're going to collect $7,000 if you were to make a trade like this. But the bid ask is absolutely terrible. And the volume here is 0 and the open interest is 5. So this right here would be an example of a really bad option. And I'll give you some foreshadowing right now for what a spread is. But if I were to sell one put, and then if I were to buy another put right below, this wouldn't even make any sense. All right, so this is going to have a really, really hard time getting filled. Look at the bid, it's negative 380 and ask is 750. So this is so bad in terms of bid ask that you want to be really careful. And Chipotle is actually a big company, but this is an example of when volume is low and when bid ask spreads are very wide, that does not make a good stock for trading options. Now, the next thing that I want to cover after this market cap is looking at the PE ratio, both the trailing and the forward PE. Okay, so the trailing PE just means what is the PE ratio right now? The PE ratio for PayPal right now is 16. That just means that when you take price of, $66, and you divide it by the earnings, okay, you get a ratio of 16. Let me make it more simple for you. If a house were to cost $100,000 and per year you are collecting $10,000 in rental income, all right, you have a price to earnings of 100, the cost of the house, 10,000, the cost of the earnings, or the earnings that you get. 100 divided by 10 is 10. So in this example that I gave you on a house that costs $100,000 and a return of $10,000 in rental income per year, the price to earnings ratio would be 10. So here, what this is saying is you are paying $160 for $10 worth of earnings. That is kind of interesting because in real estate, you collect more. But the thing is, stocks can appreciate a lot more than real estate. And this is what I like about option trading, is that option trading can make a lot of money. And then stock trading can also make a lot of money. Typically in a given year, the stock market can go up 10 to 12%. With option trading, you can have some insane results. Like I was saying earlier in this video, that I turned $100,000 into $700,000. So, but you still want to understand fundamental analysis in the perspective that sometimes it can be really high. If it's really high, for example, if I go to a company like Nvidia, it's very high because Nvidia is an AI company that's pricing in a lot of future growth. A lot of investors are very bullish on it. And you will see right here that the trailing PE ratio is 77, which is pretty insane. It's really, really insane. So to get $10 worth of earnings, you are paying $770. So if you put up $770, this company will earn you $10 per year. So that is a pretty bad return when you look at it at face value. But the thing is, you can now see the next metric, which is forward PE ratio. You can see here how Nvidia goes from 77 to 38. Now, how does that happen, or what does that mean? Well, that means the trailing PE ratio right now is 77. Again, Nvidia is making, let's say, $10, and it's trading for $770. In all reality, it's trading for $899, which means that it's probably having an earnings of $11, $12, $13, or $14 or so, give or take, right? Now, in the forward PE ratio means 1 year from today, what will the PE ratio be based on estimates, based on analyst estimates? So what's really interesting here is that Nvidia is going from 77 to 38. What's crazy about that, and what's really cool, is that means that analysts are literally predicting that Nvidia will double earnings. So if it doubles earnings, then the PE ratio will be 38. And in the future, as these earnings come in, investors will say, hey, this company is growing so quickly, I think 38 is a very cheap PE ratio. I'm going to buy it. And this is actually what drives stock prices up. They go up because the expectations of the market are that the stock is going to continue to earn more money, and investors are willing to pay more money for the stock price. And as they're buying up shares, this increases the value of the stock. So the stock's value goes up. So as you can see, the forward PE ratio here is 38. Maybe in another year, it will be 19. Maybe in another year, it'll be 9.5. Maybe in another year, it'll be 4.5. 4.5 would be a steal. So if this price of the stock were to stay the same and this stock kept doubling its earnings, then in 1 year, 19, in 2 years, 9.5, in 3 years, 4.25, who doesn't want to, put in $425 and get $100 back? You're basically having a price earnings ratio of 4. By the way, if you flip the ratio, the P is the 4. If you flip it, you get 1/4 earnings over price. So you're going to get $1 for every $4 that you put in, or a return of 25%. Now, I don't know about you, but the banks are not paying 25%. Bonds aren't paying 25%. Nothing in the world gives you a guaranteed percentage of 25% per year. So technically speaking, in just a few years, Nvidia, if it were to be doubling, would be an amazing value at 25%. Now, another year after that, it would go from 25% to 50% per year in returns. Now, what does that mean? Does that mean that you're going to get 50% returns? Not necessarily. All this means is if Nvidia were to keep doubling, the PE ratio would continue to go down and become so cheap, it wouldn't make any sense. The only way it would make sense is if the stock price rises, because that makes the P bigger. Therefore, the valuation continues to stay stable. Maybe it's not going to be 77, maybe it's not going to be 38, but as it keeps doubling, in my example, it will go to 4. But let's say investors think it should be 20 PE ratio. So the PE ratio here could go down to 20, And that means that the stock would 5x in the next 4 years in this example, if it were to continue doubling. Now, with that being said, Nvidia is not going to continue doubling because if you go to the financials, it's very unlikely to do so. So you can see here how, and I said it's unlikely to do so, but it is. It went from 16 billion in 2021. In 2022, under the financials tab, by the way, in 2022 went to 26 billion, which is almost a double. 2023, actually, it just made slightly more. But in 2024, we had a skyrocket of more than double. So if you take the growth rate here, it's not quite doubling, but it is going up and it can double, but it's unlikely to continue to double all the time. As you can also see here, Nvidia has beaten earnings over and over and over again. That's typically a positive sign of high momentum on the technical and the fundamental aspect. This is kind of somewhere both, that many earnings beats is a very positive sign for a company. So this is a very good thing. And as you can see here, the annual revenue just continues to skyrocket and the earnings have actually skyrocketed as well. Actually, the earnings went from 4 billion up to 29 billion. So analysts think that the earnings can double again, meaning that the price to earnings ratio is going to continue to fall. If you want to know what the average price to earnings ratio is, it's between 20 to 30. That's what the S&P 500 general stock market index is, give or take roughly. So you want to look for a PE ratio around 20 to 30. However, if you see a high PE ratio, that doesn't necessarily mean that it is a bad company. It just means that the company most likely has high growth and investors are predicting that the stock will go up, and that's why it is trading for expensive levels. Next, we will look at price to earnings group ratio. That's what PEG stands for, and that is the 5-year expected PEG ratio. So this just takes into price to earnings divided by growth. Now, this is an interesting metric because typically it's around 1 or 2. So here you can actually see that Nvidia is actually around 1.24. So when you take into account growth, it actually has a fantastic growth rate. Now, if we take a look at Tesla, just to give you guys a different perspective of other companies and how expensive they are, you can see here that Tesla has a very interesting scenario. Tesla actually has a PE ratio of 47 right now, but in the future, because actually it looks like analysts are expecting their earnings to actually slow down. And because they expect it to actually slow down, you can see here the forward PE ratio is actually more expensive. This is a signal that Tesla can actually be a very bad stock. If Tesla doesn't experience enough growth, this could be a stock that has to go down in value because the PE ratio is just way too expensive. Now, also the PEG ratio is also very expensive. The PEG ratio here is 3.27. Nvidia seems very expensive and it's going up a lot, and Tesla is going down a lot. But the fact of the matter is, it actually looks like Tesla is a worse value. It actually looks like this stock that's falling is worse and Nvidia is better because in the future, Nvidia is likely to grow more based on analyst estimates, whereas Tesla looks like it's gonna slow down. And because it's slowing down, the PEG ratio here is actually worse. It's actually a lot more expensive to buy Tesla. Now, taking a look at the next metric is price to sales. Price to sales is simply how much is the price of the stock, how much revenue do they have, and those two numbers are divided. So for example, you can see that the market cap for Tesla is $580 billion, and let's say that their sales is 100 billion. So if it's 100 billion, you take the market cap of 589 divided by 100 billion, you get 5.89. Here we have a ratio of 6.8, which means that Tesla has just probably under about $100 billion worth of sales per year. This is an awesome metric because it lets you kind of stabilize and compare an apple to an apple. Because if you look at earnings are not always that relevant. I mean, if you look at something like an Amazon, as they were growing, their earnings were negative for a very long time. Earnings can be negative for quite a long time, and I'll actually show you that that was also the case for Tesla, and they can quickly go into the profits. So here you can see that they were actually in 2022 broke $721 million, and you can see here how the earnings are actually going up. But if you take a look at something like we were just looking at Nvidia, I believe that the earnings were actually negative. So no, the earnings here were also positive. That's because a lot of these companies are, they're already mature. If we look at a company like Rivian, which I don't like at all, I've never recommended Rivian. This is one of my more hated stocks. I don't think the brand is too good. You can see here how they lost $1 billion, they lost $4 billion. They lost $6 billion, they lost $5 billion, okay? So although the revenue is certainly rising, it certainly does look
good, their earnings are really, really bad. So I would really steer away from a stock that has these type of elements. Like the PE ratio is non-existent because they're not making any money. Price earnings group ratio is non-existent and non-applicable because, well, they're not really making any money. They're losing money. Price to sales is 2, but that's expensive. If they're not making anything, this company has a high chance of going bankrupt. You have to pay 2 times more than sales. This is lower than Apple and Tesla, but still, I'm not really bullish at all in this company. So, let's continue on and look at other. I'm going to skip price to book. It's not as important, although some of these metrics can be somewhat important, but I don't look at these as much. Now take a look right here. You can look at the share statistics. You can see how much is held by insiders as well as institutions. Now an important metric that I look at is short percentage of float. So this just means out of all the shares outstanding and floating, how many shares are being shorted? And here it's 22.98%, which is incredibly high. Now, if I look at a different company like Disney is down a lot today. If we take a look at the short, the short is 1%. So there's a whole lot of people shorting, which just means that they think that the stock will go down. They are bearish. So they believe that the stock will fall in value. Percentage short is a good metric to really look at because it also tells you how hated is a stock. How many people hate the stock, and if it's a really hated stock, I would recommend that you not touch the stock, and maybe you can buy some put options, but you would generally want to stay away from the stock because it's most likely a very low quality company. Now, there are other metrics that you can look at. For example, like profitability, like the profit margin. This is a very interesting ratio. However, it depends on the industry. So a company like Amazon or Disney may have a very small profit margin because they're doing a lot of volume. However, if you look at a company that is more of a software play, something that comes into my mind might be like Snowflake. If you look at something like a Snowflake, it may have a lot higher profit margins. Here, actually, it has negative 29, so this is not a good stock to look at. Now, let's take a look at Datadog. I'm trying to find a traditional business in software that is just cranking out a high amount of money. Again, here is 2.28, and as you guys can see, big companies have a lot of expenses. So a lot of them are really running on tight margins, which is why you do see, sometimes companies laying off a lot of people. So let me go to Microsoft. For them, when they can save money, it is a big deal. Microsoft should have some really good profit margins. Actually, Meta has good profit margins. Yep. So here's an example of a beautiful business. This is something that Warren Buffett would look at, something that he would own because, the profit margin here is really big. It's 36% on large volume because it's a big software company. Profit margin is 36%. You can see here how the share short is very, very low. I mean, you'd be kind of silly to short Microsoft on the long-term basis because, when I was working on Wall Street, one of the analysts told me stocks just like to go up. In the long term, they're always rising. So any 15-year period, 99% of the time, stocks are going up. So it's really kind of a bad idea to buy put options on large, stable companies in the long term. Maybe in the short term, you can gamble with that, but I would not recommend it. You can see here how the shares short is very low. The price to sales ratio here is 13, which is very high. And that's because the market knows that Microsoft has a very stable, good business. And then they're willing to pay a higher price for the sales. And you can see here how the PE ratio is actually 30. So it's not bad. That means that you put in $30, you get $1 worth of earnings, or an earnings yield of about 3.3%. So in general, 3.3% per year. What I'm doing, how to get that 3.3, is I reverse 30 and I reverse it. I put 30 in the bottom, 1. So 1 divided by 30. The earnings of $1 for $30 that you're putting in is about 3.3%. So why would you settle for 3.3%? Well, that 3.3% is going to be growing every single year. So Microsoft is improving its business and earnings are growing. So the 3.3% will get more as time goes on. And that's why people buy stocks. They want those earnings. As well as dividends. There's a lot of dividend paying stocks, especially the bigger stocks. They will pay you an annual dividend. So here you can see that the forward annual dividend yield is 0.73%. So it's not really high. You're not really going to get rich off the dividend. But hey, some stocks can pay you 3 or 4% dividends. So that does add up. You get a dividend, plus you get upside. Plus, if you're doing something that I call the double dividend strategy, which is dividend paying stocks, do covered calls, you get a double dividend. You get paid dividends from the stock as well as you get paid from the covered call. You can do that on a quarterly basis, basically collect 2 dividends there, and that's a really good way to retire. That's a really good way to make
$10,000 a month, $30,000 every quarter, $120,000 a year, you can get into that retirement zone pretty quickly. With option trading, of course, you need some capital. It'll take you some time, but I've been able to achieve that and basically get into the retirement zone by, just simply doing strategies like covered calls, selling puts, as well as some other small account strategies, of course. So to go over some more of the statistics, you can look at revenue to understand how much money are they making. You can also look at quarterly revenue growth, year over year. That's why YOY stands for year over year. So year over year, how is this quarter to last quarter? And they grew by 17%. And you can see here how quarterly earnings are doing very, very well. So the revenue growth is growing 17% and the earnings are growing by almost 20%.
All right, so now we're going to be talking about the wheel strategy. So to do the wheel strategy, you need to know what a covered call is. You need to know what a cash secured put is, which I covered earlier in this course. So go back to that if you don't fully understand them. The wheel strategy involves a covered call and a cash secured put at different times. To start off the wheel strategy, all you want to do is sell a put option. Once you get assigned, you start selling covered calls to generate income on the position that you got assigned. The wheel strategy is my very favorite strategy because you can make $5,000, $10,000 a month pretty easily, especially as you scale your portfolio. I also like the wheel strategy because it's a safe, consistent option income strategy that honestly is my number one strategy because it's just so consistent. It's really easy. So first you start by selling a cash secured put. A cash secured put means that you have the cash that if that put were to get assigned, then you have the cash to purchase that put option if you do get assigned. So say that you sell a put option at the $100 strike of a different stock, let's say it's Apple, then if you get assigned at $100, that's basically a $10,000 position. You can also sell a put option on something cheap like American Airlines. That would be $1,400 if the strike is 14. So a covered call means that you already have the cash set aside in the account as well. So whether it's selling a put option, you do need to have the cash set aside, or a covered call option, you need to have 100 shares of stock. So again, this is a capital intensive strategy. So you will want to have a stock 100 shares of. So like that could be Palantir, that could be anything that you can afford 100 shares of, or vice versa. If you're just going to sell a put option to get into the strategy, then again, you need to have that cash laying around. If those are too expensive for you, you do have to look for the cheaper strategies that I will cover later on in this course. The point of the wheel strategy is that you're never afraid to get assigned. You are never ever afraid to get assigned. So if you sell a put option, you're perfectly happy to get assigned 100 shares. If you get assigned and you have those shares, you sell a covered call. If the covered call gets assigned, you lose your shares. You're also perfectly happy. You're just generating income on both sides. You're generating income from puts. You're also generating income from selling covered calls. So you should never be frustrated or upset if you sold a put option, you get assigned. Yes, it can go very into the money and that can be difficult to run the wheel strategy, but in like basically 90% of cases, it'll be very easy to run the wheel for consistent passive income. So I wouldn't really worry about it, especially if you're using high quality companies. Once you've chosen the stock that you like, now you have to pick a put contract with a relatively safe strike price with an expiration date of 30 to 40 days. You can use shorter term expirations. You can also use longer term expirations. I prefer to go for monthly income, so I will pick an expiration date that's 30 days out. And also my sweet spot delta will be about 30 as well. So after working for Goldman Sachs, looking at lots of research reports, what I realized was that selling options is way more profitable than buying options. I also realized that if I'm going to be selling put options, this is fantastic for having safe passive income. It's fantastic for growing a portfolio. Selling put options to run the wheel strategy is specifically very good in volatile markets because when volatility is high, selling options is better. When the market goes down, you make more money than an average stock investor does using the wheel strategy because selling puts to get into a stock already gives you that margin of safety as well as cushion, because when you're selling a 30 delta put option, or let's say you can also sell 25 delta, anywhere between 20 and 30 delta is a really good sweet spot. You'll actually get assigned about 3 out of 10 times on a 30 delta. If you're doing a 20 delta, you'll get assigned about 2 out of 10 times. Obviously, the less out of the money your strike price is, the higher premium you're going to collect. But in general, and especially for beginners, the wheel strategy is not about getting greedy. It's about safe, consistent returns. So you generally want to pick a strike price kind of far out of the money. You can also go under 20 delta. You will get paid a lot less. If you have a bigger portfolio, this will favor you. Now, if you have a smaller portfolio, you may even decide to go a little bit higher than 30 delta because you get paid more. The most important thing isn't how many dollars it is out of the money, but how likely it is to go into the money. So again, you can go $1 out of the money. That could be really good for a cheap stock like American Airlines. That could also be not that far out of the money for a more expensive stock like Tesla. So it's not necessarily how many dollars you got out of the money, it's how far away you go as a percentage basis. The risk in option trading is that in the short term, you may get unlucky, but in the long term, if you're using the strategies that I'm teaching, you are going to be very successful over a longer period of time. Just like in a casino. If you were to go to a casino and you were to make one big bet, that's actually very scary for the casino because the casino could lose in the short term. However, if you go to the casino and you just keep doing $10 bets over 1,000 times, you are virtually guaranteed to lose because the casino has a small edge. So what I'm teaching mostly on my channel is actually option selling, because option selling makes you the casino. You become in the power seat where you're making consistent income using the strategies and the techniques that I'm teaching you because I know that they work. So when you sell a put option, that option is going to decay every single day. You can buy it back at any point because there is theta decay. That option is becoming less valuable. And because it's becoming less valuable, that's a really good thing for you because you're able to buy back that position for a gain. As long as all things stay even, that theta will be kicking in. Of course, if that stock goes down, then your put option may be at a slight loss, which again is fine. If you take assignment, you have 100 shares now and you're in the perfect seat to do covered calls. Okay, to explain the expiration date, 30 to 40 days is a pretty normal expiration. Anything much longer than that, and we're starting to get into the risky territory because so much can happen past 40 days. The thing is, you can sell puts that are beyond 40 days. This really depends because if you're picking a high quality stock, you really don't mind. So you can do longer term options and you will actually get compensated more. So when you go out, that's 60 days, 90 days, or multiple months, the compensation to you comes faster because you have to take all that upfront risk right away. However, I will say that the most profitable trading is between 1 to 6 weeks. That's because that's when theta really kicks in. You can see a chart right now on the screen. Theta really speeds up towards expiration. So as expiration approaches, the theta is becoming more and more. This means that the option is decaying in value. Again, if you're an option seller, which is what the wheel strategy is about, and this actually benefits you. If you're an option buyer, this is why buying options is better to go out longer term because there's a lot more that can happen. However, I will say that one of my strategies is to buy shorter term calls, but that's a more advanced lesson than this course. Anything shorter than 30 or 40 days and the premium isn't going to be that good. However, the expiration is so short, so you can do that many times. You're going to want to experiment with this. Again, for me, it's 1 to 6 weeks, and there's much more that goes into it. I also like to really understand the stocks that I'm paying attention to, and my list of stocks is only about 25 or 30 stocks. That way, I can make really good decisions and keep trading the same stocks over and over again. So once you find a strike price with a delta around that range and that expiration date, it's time to sell the put option. This is of course the most fun part where you get to collect your premium upfront, and then as soon as you collect the payment, you should be watching your position to see if the stock price starts getting close to your strike price. In most cases, it's really not going to do anything. When you sell an out of the money put, most stocks just typically go sideways because most days stocks are not really moving that much. Sure, they might move 0.5%, 1%, but if you're selling a 3 or 4 or 5% out of the money put option, in most cases, you actually don't really need to do much. You can monitor the trade every few days, but you do not have to look at it all the time. In fact, I have so many students that are doctors, dentists, lawyers, software engineers. They're very busy professionals. They're already making a high income. So even when they do make $10,000 per month doing option trading, they still have a very busy life. So they don't necessarily want to look at their portfolio. And I always tell them that's completely fine. You're not going to get better results by being obsessive over your portfolio. The fact of the matter is actually really good to set a position and just completely forget about it. You can check on it every couple of times per week. It's also not really worth rolling this type of position because since your goal is to get assigned, I typically would not roll a short put position or a sell put position because I'm happy to own it. Unless I, for some reason, change my mind about the stock or I slightly want to have a different entry point, then I can roll it using the dog strategy. But in most cases, this is not necessary at all because once you get assigned, you can do covered calls. And by the way, I would also do covered calls around a 20 to 30 delta. I have just found that that is a sweet spot for me. So after that, if the option goes into the money again on the covered call, you do have a decision here. You don't have to lose your shares because oftentimes you'll be generating a lot of money with the wheel strategy. And if you're up a lot on the stock, then you might not want to get rid of it. You may say to yourself, hey, I want to hang on to this. That's where rolling comes in. You can roll the in the money covered call. You can roll it up. You might not roll it up to become out of the money, but you can roll an in the money option up until it becomes out of the money. money. You can do that on a weekly basis, you can do that on a monthly basis, or you can even go farther than that. The whole goal is that you're going to be stepping up and rolling up if you don't want to lose the stock. If you're okay losing the stock, that's perfectly fine as well. You're going to be making money regardless. Some really successful option traders that I know literally only use the strategy. They want to have a very boring strategy for whatever reason, whether they're retired, whether they already have a big portfolio and they're just doing this to generate extra income. They're very lazy with it, and that's perfectly fine. I'm also a lazy trader myself. I don't like to trade too often because over trading is a very big issue. So if I had to pick one strategy to recommend to people who are looking to retire safely, I'd always recommend the wheel strategy because it's so good and it has such big results. The last thing I should mention about the wheel strategy is that when you're about to sell your covered calls, you need to take into account your cost basis. And to explain what cost basis is, I'm going to show you an example. Let's say that you've sold a 165 put option for 1 week and you added, 30 cents in premium. So now your break even is 164.70. That's because when you have a put option that's at 165, you collect 30 cents. Now you have 164.70. So when you get assigned, you can count your cost basis minus the premium that you collected. And in theory, as you keep running the wheel strategy, you can basically get your average cost down to zero. Why? Well, let's just take this example. Let's say we go back to the 165 put. So you sell a 165 put, you get paid $1. Nothing happens, you don't get assigned. Next week, you get paid, and again, $1. You do the same 165 put. Nothing happens. The stock goes down, but it doesn't reach 165. And so on and so forth. Let's say the following week, it's more volatile, you get paid $2. The following week, you get paid another $1, okay? Now, if you were to get assigned, you've already made $5. You made one, and two, and then another one. So now you've gotten paid $5, and let's say you do get assigned at 165. Well, in theory, your cost basis is not 165, it's 160. So once you get assigned, let's say that you sell a covered call and you sell a covered call for $5. You don't get assigned. Let's say the stock just goes sideways. You sell another covered call, you get paid $3. So that can keep happening and your average cost can keep going down every single time you collect premium. So in theory, you can actually have a position that you pay nothing for because you've collected so much premium over time to basically compensate your average cost to become zero. That means that, basically you're in a really good position and you can do anything that you want with that stock. That also means that when you get to the second part of the wheel strategy where you have to sell covered calls, you want to pick a strike price that is above your cost basis. So if your cost basis is 160, then you probably want to do a covered call that is above 160. Otherwise, you'd be selling your stock for less than your cost basis, which is not going to feel really good. The covered call is best used on really high quality companies. So for me, that's Apple, that's Google, that's Microsoft, and that's other high quality companies that are in the S&P 500. I typically like to go for blue chip stocks that have a good reputation, good brand. That way, they are very predictable. And on a predictable stock, running the wheel strategy is fantastic because you're collecting income on the puts, you're collecting income on the covered calls, and the stock is typically bouncing up and down. There is some volatility, but not a huge amount of volatility. And that's what makes the strategy so good for retirement. In fact, I would say that once you have an account that's, $50K, $100,000, then you can basically run a majority of your portfolio just using this strategy.
Hey guys, I hope you're enjoying this course so far. As you can see, I'm filming in a new studio because this course is being filmed over many days. So if you could please share this with a friend or at least one person that you think could benefit from this, that would be greatly appreciated. So continuing on, now that you understand covered calls, cash secured puts, and how one type of option works by itself, you're ready to learn how you can combine different types of options to create what we call spreads. A spread is simply two or more option trades placed simultaneously. Usually you buy and sell an equal amount of option contracts. When you combine two or more types of option trades together, you can form all different kinds of strategies that benefit in different market conditions. Once you understand these few basic spreads I'm going to teach you, it'll open up the doors to literally 90% of option strategies. And I want you to pay special attention to this in this part of the course because spreads are absolutely awesome and they're really good for scaling a small portfolio. They allow you to take a limited amount of risk with a small amount of capital and to get a lot of money back with a high probability of winning each trade. They also allow you to actually make super consistent income. For me, spreads is literally like the ultimate way to growing a small portfolio. And when I started out with just $2,000, I grew from $2,000 to $7,000 in a given year. That year was pretty difficult. I didn't really know what I was doing, but spreads were a huge part of that. And then I took $7,000 to $17,000. And then from there, over a number of years, I finally got it past the seven-figure amount. And spreads were literally one of my biggest components for doing that. In fact, back in 2021, I turned $100K into $700,000. That is 7x return. And a big contributor to that was spreads. I was using spreads on Tesla to multiply my money quickly. Although Tesla was one of my biggest contributors, I've also traded many other stocks, Apple,
Google, Microsoft. I personally like to stick to technology companies because using spreads on tech companies gives you the best of both worlds. It gives you high implied volatility, which means the stocks are moving up a lot. You can make a lot of money quickly. It gives you good risk reward ratio, which is also very important for me. And honestly, I really love the limited risk that I have with spreads. So first of all, I love taking a limited amount of risk because, well, nobody wants to risk everything. That would be completely silly. That's not proper risk management. And many people, they have just one big position or they have too many small positions. None of those are actually going to give you the big results. You need balance in your portfolio. That's where spreads really come into play. If you have a smaller portfolio, you can use spreads to just put in $500 per position, and now you can diversify while also having a high returning position, which is a spread. So let's start off with the most basic type of spread, and that's called a vertical spread. Okay, a vertical spread consists of either 2 calls or 2 puts in a combination with each other. Out of those 2 calls or puts, one of them is a long position and the other one is a short position. Basically, you sell one call, you then go ahead and buy another call. You sell one put, and then you go ahead and buy another put, okay? And just for those who aren't familiar, long just means you're buying, and short just means that you're selling. Also, the long and short positions have different strike prices, but the same expiration date. You'll be able to see that on the screen here. I'm going to pop up an image of an option chain. And if I buy one strike price and short another strike price, you will see that this creates a spread. Visually, you can see why it's called a vertical spread. Now, within the vertical spread, there are multiple kinds of spreads that you can do. And I'm going to make this as simple as possible for you to understand. I'm going to go through each one very slowly. The first one is called a bull call spread. You can remember that because it's made of 2 calls and it's a bull strategy, meaning that you want the stock to go up. You should also know that some people call it a call debit spread because you pay a net debit. So when you pay a net debit, you are paying money because you expect a certain outcome to happen and you can multiply your money. You're making a bet, you're paying, and then you have an outcome, okay? In other words, you pay, let's say $50 on the spread, but you can make up to $500, so you can 10x your money. So let's visualize it to help you understand. A bull call spread starts with buying a call option. But before I show you what the whole spread looks like, let's first compare if I were to just buy a call option by itself for $8 at a strike price of $185 and say that the market price of the stock is currently at $190. Your potential profit and loss chart for this option is going to look like this. As you can see, the vertical axis represents your profit loss low to high, and the horizontal axis represents the stock price low to high. If the stock price goes below $185, the maximum amount of money I can lose on the option is $800, which is what I paid for the contract. Remember that an $8 cost is $800 because it controls 100 shares. Now, my breakdown, aka the price of the stock needs to go for me to make a profit, is going to be $193. Your break even for the calls can be easily calculated by adding your strike price and the premium that you paid together. And lastly, my maximum price is infinite in theory because the underlying stock can keep going up higher and higher, making my option more valuable. And the higher it goes, the more money my option is going to be worth. So that's what buying a call option is going to look like by itself. To make this a bull call spread, I need to also short a call option at a higher strike price. So let's take a look at how everything changes when I short another call option at, say, $195, for example. And let's say that for selling this call option, I get paid $2.50 per contract. This is obviously going to change how our profit and loss chart looks like. As you can see on the screen, my max loss is what I paid for the spread in total. And on most brokers, you can easily pay for the entire spread in just one transaction. On Robinhood, at least, you need to be approved for level 3 option trading to trade spreads because it's considered an advanced strategy, but it's really not that complicated if you follow through with this. Anyway, in this case, the total spread price is going to be what you paid for the call option minus the premium that you got paid, which is $250. So now your max loss is $550 instead of the original $800. You see, you actually reduced your cost. You subsidized your call option by selling another call option. And this is not including if you get assigned on the option that you're selling. I'll cover assignment later in this video.
So I reach my max loss if the stock price is at or below my lower strike price of 185 because both of my calls would expire worthless at that point. And not only is your maximum loss less, but your break even is also less. Now, instead of 193, I would only need the stock to go up to 190.50 to break even. However, there is a trade-off for a lower loss and break even. Of course, all things in life have trade-offs, which would be that your maximum profit is now capped. It's not unlimited. However, I'm going to explain to you why this is actually more advantageous. You can easily get your max profit for any spread by just seeing how wide your spread is. In the case, my long call is 185 and my short call is 195, making my spread $10 wide. That means if the spread expires when the stock price is above both of my strike prices, they will make a maximum profit, which will be $10, which you need to multiply by 100 to get a real maximum profit of $1,000. So we can assume that the width of our spread will always be equivalent to our maximum profit. And just in case that this doesn't quite make sense to you, let's prove it by going through a quick scenario. Let's say right as the spread expires, the stock price is above 196. So $1 over our top strike price. Then my long call would expire $11 in the money and my short call would expire $1 in the money. And since options always lose all of their extrinsic value at expiration, that's exactly why and how their total value would be as well. So to close out this spread and exit our position, all we would have to do is sell our long call for $11 and buy our short call for $1. So we would make a net profit of $10. And of course, most brokers let us do this all in just one transaction. And from here, you can assume that you can't make any more than $10 because even if the stock goes up by more than $5, we'll make $5 more on the long call, but we're still going to be losing $5 on the short call. But realistically, you're going to want to exit your bull call spread before expiration. So it's even if the stock goes past the short leg of your spread, it's not going to be worth $10 because the extrinsic value of the short leg is going to be more. Options that are closer to being at the money are always going to have more extrinsic value. So since your short leg is closer to the stock price, you're going to be paying more to buy it back. So realistically, if the stock goes up above both strike price expirations, depending on how much time you have left, your spread might still be worth something like $7 or $8.50, but it's not really going to be worth the maximum of $10, which is completely fine because if you end up closing a position early, say that you opened up a position that's a month out, and if you ended up closing a position in like a week or 2 weeks and you made $8 out of $10, that's really good. That's fantastic. That's pretty much my exit point. I either wait until expiration, or if I can get $7 or $8 or 70 or 80% of the bull call spread's value, then I'm going to do that if I can do that early. And it's important to know your maximum value because once you start to see the value of your spread getting close to its maximum, you should be taking profit. There's absolutely no reason to risk losing it all just to get the extra $1 or 50 cents unless you're really close to expiration. In that case, sure, it makes sense. For me, I do close bull call spreads quite often and quite early. If I can see even a profit of 30% in 3 weeks, to be honest, I'm really happy. Or 30% in 3 days. It just really depends. For me, I look to close an option before the 50% mark. So if it's a month out, I look to close it at 2 weeks. If it's 2 months out, I look to close it at 4 weeks. Okay. Only though, if I have made a certain amount of profit. That profit isn't specific. Sometimes for me, it might be 30%, 40%, or 50%. You need to set this goal before you enter the position because coming in with the plan is going to make you a lot more successful than trying to figure out in the moment. Because what happens, and I've seen this over and over again from coaching 4,000 students, they typically get greedy. And if you get greedy in the moment, then you're too much into the situation to really understand logically what has happened. So you need to zoom out, have a plan when you go into the situation, and then once you're in the middle of the situation, don't get emotional. Use logic and take your profits early if you see a really good return in a short amount of time. Lastly, I know some people are going to have this question in their heads. What happens if I get a sign on the short call part of my spread? Because if the stock goes above my short option, technically the buyer has the right to exercise. So usually the buyer will never exercise on you when there's still time until expiration because it is just
really, it just doesn't make sense. They would just be throwing money out of the window into the trash can by not selling the option instead of cashing it in on the extrinsic value. I mean, if you even look at it right now, nobody's going to be exercising options early because the value of an option is usually a lot more than exercising that option. So it actually doesn't really make sense. A lot of people are afraid of exercising or assignment, but typically that doesn't happen, especially in the spread example. The only reason that it happens is if the option is very close to expiration. Let's say there's only 1 or 2 days left, that option is in the money, then yes, your chances do increase. And I do recommend closing out a spread that's in the money by a lot in the last few days. But that's actually not true for buying spreads. So in the example of a bull call spread, you don't have to worry about that. You only have to worry about it in the case that we talk about selling spreads, which we will talk about shortly. So most of the time, you won't have to worry about early assignment, but yes, it's very unlikely, but still possible. The only time it might be likely that you get assigned early is if your short option is super deep in the money, but at that point, it will have so little intrinsic value that you should have already closed your position and taken your profit anyways. Cool. So now that we have covered the bull call spread, which is the first out of the 4 types of vertical spreads, also 2 vertical spreads are categorized as debit spreads, meaning you have to pay to enter them, and other 2 are categorized as credit spreads, meaning you get paid to enter into them. Since we just covered the bull call spread, which is a debit spread, the next one I'm going to be talking about is the bear put spread, which is also known as the put debit spread. And there's a reason why I'm covering the debit spreads together first, because as you're about to see, the bear put spread is the same exact thing as the bull call spread, except you want the stock to go down, hence the word bear being in the name. So again, let's show the graph on the screen now. A bear put spread starts with buying a put option. But before I show you what the whole spread looks like, let's first compare if I were to just buy a put option by itself for $4 at a 58 strike price expiring in a month. And say the market price of the stock is 55. Your potential profit and loss chart at expiration is going to look like this. If the stock price goes out of the money and above 58 strike, I will lose 100% of what I paid for the contract, which is $4. So the maximum amount that I can lose is $400. My break-even price for this put option is going to be my strike price minus what I paid for the option. So $54, meaning I need the stock to go below 54 to make money at expiration. And lastly, my maximum profit can technically be quite a lot in even close to infinite, but of course, the stock can only go down to 0. It can't go below 0, so you can make a lot of money up until 0. That's irrelevant because most of the time it's just not going to happen. To make this bear put spread work, I need to also short a put option at a lower strike price. So let's look at what happens when I short another put option at 52. And let's just say that for selling the put option, I get paid $1, so a real amount of $100. So now my max loss is $300 instead of $400 because, well, I just got paid $100. I reach my max loss if the stock price is at or above the higher strike, which is 58, because both of my puts would expire worthless at that point. Now, let's talk about our new break even. Instead of 54, I would only need the stock to go below 55 to break even, because this time I didn't spend the $400. I only spent $300 because I again get subsidized. When I sell a put option, it actually pays me $100. And lastly, let's just go over our maximum profit, which you basically come to the point of noticing that you would have a very high maximum profit again. You would be capped if the stock were to go down to 0, but here, everything under the break even is going to be pure profit. If you remember from the last spread, we can also automatically know our max profit from the width of our spread. So here, in this case, it wouldn't be unlimited because now we're not just buying a put option. So our spread is $6. And to reach that maximum profit, the stock just needs to go down to $52 by expiration. That means we're essentially risking $300, our max loss, to make a potential $600, our maximum profit in this scenario. For me personally, I prefer bull call spreads. The reason for it is because market typically goes up. I personally almost have never bet that the market is going down. However, if you spot an opportunity of a stock that you think has, for whatever reason, a bad business, bad management, or just technically has bad negative momentum, it's going down, you think it's going to fall, this would be a good time to use this strategy. For me, I follow also very similar rules here. If I made 30 to 50% in just a couple of weeks, then that's a really good opportunity for me to take profit and close out this position. If the stock continues to go down, then I'm going to keep holding the position. It's really on a case-by-case basis, and you do want to use intuition. The most important thing is you want to make sure to use a strategy on a bearish stock. So those were the two debit spreads. Now we can go over and talk about the two credit spreads. These are actually my favorite strategies to growing a small portfolio and making consistent income, meaning you actually get paid to enter them. The first one is called a bear call spread. It's also made up of two call options, except it is different from the bull call spread in that you want the stock to go down, or the stock can even go sideways. It's also known as a call credit spread. As you might have already guessed by now, with the spread, you generally want the stock to go sideways. It can go up a little bit, and you prefer it to go down, okay? The good news here is that you sell a call option first, you sell the closer to the money call, and then you buy another call option that is farther out of the money. The one that you sell is more expensive. That means you collect income, and the one that you buy is less expensive. So it gives you protection, but it costs a lot less money. So you actually end up having a net credit. You end up collecting income. With the spread, generally, you will be making money as long as the stock price stays below both the strike prices of your spread. But it can go even up a little bit. You can also go down a little bit. And you can still see a full profit. So first, you're going to want to start by shorting a call option closer to the strike price. Then the long call option you're going to buy later. For selling the $102 call option, I will receive a premium of $1.50. And to buy the call option at $106, the option I'll have to pay 50 cents. That gives me a net credit of $1. So I'll actually get paid $100 to even trade this spread in the first place. And $100 is also our max profit. That means my break even is going to be $103. So I need the stock to fall or stay below at least 103 to make money. This is really good for a range bound stock or any stock that even goes up. You just make sure that it doesn't go past your strike price. So that's why when I trade a call credit spread, I always pick out of the money options. I go further away. For that reason, there is a less likelihood that the stock will go up to that level. So I do pay attention to technical analysis for that. But the ultimate goal is that both of our calls expire worthless and that we get to keep the entire premium that we collected and we don't have to close out the option. We don't have to pay anything to close it out. We don't even have to do anything. As long as the stock stays below the strike price, we're in good shape. We just wait until expiration. Now, to calculate our maximum potential loss at expiration, we need to find the width of our strike. And our width here would be $4. Then we just need to subtract what we got paid in the first place. So our width is $4, but we got paid $1 to enter this trade. That leaves our maximum loss at $3 or a real max loss of $300. You can see that the way we calculate our max loss and max profit is actually the reverse for a credit as it is for a debit. So the stock goes up a lot, it's going to be really bad for our short call, but our long call is there to protect the downside and cap our maximum loss. With the spread, we're essentially risking 300 to make a potential 100. You might be thinking to yourself, well, why would I want to risk 300 to make 100? Just to give you an example, what if the chances of winning the 100 were 90%? But the chances of losing 300 were 10%. So that would be a profitable position to make because you would win well over to make a positive profit on your hands. If we compare this to the last debit spread we went over, it seems like the debit spread is actually better because we're risking 300 to make 600. But the thing is, it's more likely that the stock is going to stay below a certain price for the credit spread, and it can even go up for the credit spread and you can still end up making money. Whereas with the debit spread, the stock has to go up. It has to move up to a certain price for you to make profit. If it doesn't do that, you're not going to make any money. So that's why it's actually really beneficial to have a credit spread because you actually need something not to happen, okay? It's really beneficial because most of the time you win, whereas with debit call spreads, to be honest, it can be pretty hard sometimes to win, but when you do win, you hit really hard. So it just comes down to risk and reward. If I'm going to be choosing a strike price for a call credit spread, basically, here's what I would do. I would just go out of the money. I typically like to go for a delta around 15. Yes, that's a low delta, but that also means that I'm going to have a very high chance of success. I mean, if I pick a 20 delta, that means the chances of this option going into the money are 20%, which means that if it doesn't go to the money, which again, for a call credit spread, you don't want it to go to the money, then you end up making 80%. So it's really fantastic. You win 80% of the time and 20% of the time you have a loss. And that's really important how you manage your loss. And we'll be talking about rolling options, adjusting options, and how we manage those positions shortly. Now, the last vertical is called the bull put spread. As you can probably tell, it's a bullish strategy using puts, and the alternative name for it is called a put credit spread because you're going to get paid to enter it. Generally, you're going to be making money as long as the underlying stock stays above your put spread, but you can still make money if it goes down just a little bit. So first, you're going to want to start with shorting a put option closer to the strike price that the long put option you're going to be buying later on. So we're going to start off this example by looking at a short put option at $98, and I'm going to be buying a put option at $94. For selling the 98 put option, I will receive a premium of $1.50, and then I'm going to buy a put option at 94 strike, and I'm going to be paying 50 cents. That gives me a net credit of $1. So I'm going to get paid $1 to trade this spread. And that's going to be $100, and that's going to be our maximum profit. That means that my break even is going to be at 97. So I need the stock to stay above or at least at 97 to make any money. But we want both of our puts to expire worthless, so we get to keep the premium that we collect. To calculate our maximum potential loss at expiration, we need to find the width of our spread, which is $4. Then we just need to subtract what we got paid in the first place to put on this trade, which is $1. That leaves our maximum loss at $3 or a real max loss of $300. So if the stock goes down a lot, it's not going to be good for our short put, but our long put is there to protect us on the downside and cap our maximum loss. And just like the bear call spread, we're essentially risking $300 to make a potential $100. Pretty simple, right? So for me, a put credit spread is literally one of my favorite strategies, and I'm going to go over an example right now and show you how the put credit spread works, how much money you can make put credit spreads, and we're going to go into those details right now.
All right, let's talk about put credit spreads. So let's go over an example right now. I'm going to use Apple stock. So I'm going to click Apple right here, and then I'm going to open up a put credit spread. Actually, you can see right here how I'm up 380K on the stock, and it does make up a significant portion of my portfolio. Again, if you want to see all of my picks, I do have a link in the description where you can actually check out my community where I post every single trade that I make. Now let's go to trade Apple options. The first thing I'm going to do is I'm going to sell a put option. Now, the best expiration date really varies, but anywhere from 1 to 6 weeks is going to be perfectly fine. The reason is because options actually expire. The reason is because theta, or time decay, actually kicks in very heavily in the last 1 to 6 weeks, specifically in the last week, but going 6 weeks is also perfectly fine. Now I'm going to pick an expiration date that's going to be in the future. Let's go for an expiration date that's 1 month out. Now what I'm going to do is I'm going to sell a put option. I'm going to sell an out of the money put option on Apple. And what I'm specifically looking at right now is delta. I want to sell a low delta. The lower the delta, the lower the chances are that the option is going to expire in the money, which is a good thing if you're an option seller. I'm going to move up right now to the 220 strike, and you can see right here that the delta is 0.19, which is pretty good. That means that I'm going to win about 80% of the time, and 20% of the time, this option will go into the money. So that's perfectly fine with me. I'm going to go sell put option, and then I'm going to click right here. Now, if I were just to make this trade right now, you can see here on the top right, it says cash secured put. So I'm just selling a put option, but to actually make this a spread, now we have to go ahead and buy a put option. So first we sold a put option, now we're going to buy a put option. For me, I like to buy a put option one leg down, typically. I really like the width of $5. A $5 width is pretty much the best. I'll tell you why. If you're doing spreads that are $1 width, it's not ideal because every time you're trading, you are actually losing a little bit of money because there's something called the bid and ask spread. Here the bid is 1.3 and the ask is 1.35. That means every time that you're trading, there's a little bit of a difference, actually a couple of dollars that you're losing out on. So if you're doing a lot of quantity of $1, $2 spreads, that's not ideal. I'd rather do a $5 spread and do a little bit lower quantity but lose less money when I'm making the trade. There is implicit cost and explicit cost. This is going to be an implicit cost because it's not really factored in, but you could factor it in yourself because now you know. So I'm going to go ahead and buy this 215 strike price, and now you will see something very interesting. So now it says put credit spread, and the difference is $5. And you can see here I have a net credit of $75, or roughly $75 to $80. That is actually going to be my max profit. My max profit is what I collect on this option trade right here. So let's just say $80 is how much I'm making, and I can lose $420. Now, why is it $420 and not $500? Well, when I'm making a $5 width spread, that means I'm risking $500. But because I'm collecting $80, that means that the difference is going to be $420. So at most, I can lose $420.
My max profit is 80, my max loss is 420. Now, let's talk about risk management. Risk management is super important if you want to properly make money on a put credit spread. Now, let's be honest. If you make $80 and then you lose 420, obviously you are in the hole. So how do you end up actually making money? Well, there's several ways. First of all, this spread right here has a very high chance of being out of the money or has a very high chance of you profiting. By using technical analysis and by using good intuition, picking the right stocks, you can tilt the odds even more in your favor. That's exactly how you make money trading options. This is actually a very hard game to play because everyone in the world wants money and everyone is playing this game. But if you want to tilt the odds in your favor, you're going to pick high quality companies, you're going to use out of the money options, and you're going to use proper technical analysis. Now, in terms of closing this position early, if this position goes into the money, you can think about closing out this position. So for example, if Apple goes down to 220 from the current stock price of 235, then you can start thinking about closing out this position for a loss and managing your risk, okay? So if it goes to 220, you can ask yourself, do I think it's going to go lower? If yes, then you can close out this position. If you're still bullish on the stock and you don't have to use Apple, you can use any stock, then you should basically not close out this position. I have noticed that the biggest raw returns that I get, the biggest returns period, is by holding the option until expiration. And that's what I teach in my community because I like simplicity. I like to do the least amount of work and make this income as passive as possible. However, there are people out there, especially many of my students who are engineers, that want a system. They want to know exactly when to close. Well, the bad news is that option trading isn't really a science. It's much of a science as it is an art form. So for me, every situation is a case-by-case basis. Sometimes I will close, and other positions I will hold until expiration. For the majority, I hold until expiration. And I've had situations where I was down like $15,000 only to wait until expiration and be up like $15,000. So $30,000 difference just by waiting and being patient. So it's not always the case that doing more makes more. In fact, in option trading, doing more sometimes makes less. Now, for the best stocks that you should use for a put credit spread, again, you want to use high quality blue chip stocks. And something that you don't want to do is, for example, I'm going to show you CMG. This is just as important to avoid as it is to trade properly. Now, Chipotle has had a stock split, so this isn't as good of an example, but before, and I'll show you what I mean by this, but before, when this stock was really expensive, it was extremely hard to trade. For example, the bid and ask spread was very wide. Now, check this out. This bid and ask spread is actually 15 cents off, which is $15 off. Very different from Apple. Apple was like $5 off. This is 15. That means every time you trade, although your brokerage could be free, this is still going to be an expense of like over $5, $7, $8 potentially. So this is really, really bad, especially if you're opening up multiple legs. Now, check this out. This is going to be completely what you don't want to do, all right? So let's say I want to sell a put. I'll show you exactly why I do $5 width. So these are really weird because of the stock split. So check this out. Let me go for 62, let's do 62.3, all right? I'm going to sell this, and then I'm going to buy, let's say 62.1. Let me show you how whack this is going to be. This, like, look at this. You see, it doesn't even show you a risk because these options are so illiquid. They're so bad. Like, you see 460 and 730. That is so bad. In fact, it's so bad that Robinhood is telling you that there's a maximum profit of $50 and no max loss. But that's incorrect. You're just not going to get filled. Like, if I click continue here, you'll see that the bid is negative 230 and the ask is 330. Like, literally, it is going to be very, very difficult for you to get assigned or even like place this trade. You're just not going to get filled on the trade. That's really, really bad. So it says 0.5 here. And, if I were to enter 0.5, the chances of this actually getting filled are very, very slim to none. So, if I were to put in 0.2, yes, maybe this would work, 0.2, but still, this would be an example of a very bad bid-ask spread to trade. So it's really important to pick the high-quality companies, and it's really important to pay attention to bid-ask spread. So let's talk about how to use all four of these vertical spreads. When would you want to use them, and what outlook are you looking for in the stock? So specifically, what you want to do for the bull call spread is that you're expecting the stock to go up. So you're looking for a stock that's bullish. When a stock is bullish, using the bull call spread will give you money. You'll make money. And that's a specific strategy where you're buying a call option that's closer to the money. So you're going to have a net debit, but you have a whole lot of money to make. If it goes up, this is literally the best strategy. I've made so much money on Tesla by doing bull call spreads. Next, we have the bear call spread or the call credit spread. So a call credit spread is basically betting that the stock won't go up.
you want it to stay lower, because if it goes up, then you're going to end up losing money. Then if you talk about the put debit spread, which you're paying for a put debit spread, you're paying for a put. If you're paying for a put, that means you think the stock will go down. Okay? I usually don't use this strategy, but you can use it for a stock that is going lower. Then a put credit spread, which love it, love it, love it, love it. You just saw an example of how a put credit spread can make you a lot of money. Debit spreads are for high volatility, expecting strong price changes, and credit spreads are for low volatility, experiencing or expecting little to no price changes in the underlying stock. For me, the best vertical spread that I typically do is going to have a $5 gap. For me, $5 is very simple. You can also use a $10 gap. And for some small portfolios, if you're selling put credit spreads, you can go for a $2 or $3 gap. Now we're going to get into the horizontal spread. Horizontal spreads are the opposite of vertical spreads, because a vertical spread here is basically just two options that will have the same expiration date, but different strike prices. With a horizontal spread, your two options will have the same strike price, but different expiration dates. The different expiration dates being the key characteristics of this type of spread is why it's also referred to as the calendar spread. So if you hear the term calendar spread or horizontal spread, just know that they are the same thing. A lot of different strategies in option trading have multiple names, which can be really confusing, but don't worry, I'm going to explain to you as simple as possible. Anyway, there's a long horizontal spread, aka buying a horizontal spread, and a short horizontal spread, aka selling a horizontal spread. And with this spread, you can buy the calls and sell calls, or buy and sell puts. However, I won't be covering short horizontal spreads because they technically have unlimited risk, and I think it's probably not necessary for a beginner course. We're going to start with the long horizontal spread, and we're going to use an example of specifically buying a horizontal call spread to help you understand. This strategy is generally used when you expect the underlying stock to stay relatively stable or to only move slightly in your favor. In order for you to buy a horizontal spread or pay a net debit to enter the spread, the long call that you're buying needs to cost more than the short call that you're going to be selling. If we know that only the expiration dates can be different, you can assume from what you've learned about the expiration dates affect the price of the option, that the long call has to have a longer expiration date, and the short call because the longer expiration dates are more expensive. Let's say that Visa is trading at $280, which it is pretty close to that at the time of this recording of the video. And let's buy a call option at $279 and 60 days until expiration. Now, let's sell a call option also at $279, but with only 32 days until expiration. And for that, I'm going to receive $6 in premium. So in total, to enter this horizontal call spread, I'm paying $4, or a real price of $400. Now, as time passes and my two options start getting closer to expiration, I'm going to want the stock to stay relatively close to my strike price of $279. I'm also going to need to watch the stock pretty closely, so keep in mind that this strategy does require some management. To close this spread, I just need to do the reverse of what I did to open it. And that's true for a lot of different option trades. In fact, all of them. To reverse any trade, you just buy back or you sell back the trade that you opened up to begin with. So I need to buy my short call back and sell my long call. In order for you to make a profit, you have to sell your long call for more than you buy your short call for. And the reason why you benefit from the stock staying close to your strike price is because the theta decay will destroy the value of your short call much faster than your long call, since your short call has a shorter expiration date. Let's say in 32 days at expiration of your short call, Visa stays at the same price of $280 and your short call is now only worth its intrinsic value of $1, but it's lost $5 of extrinsic value. And your long call still has about a month until it expires, so it only lost $4 of extrinsic value, and now it's worth $6. So to exit, I'll make $600 from selling my long call and pay $100 to buy back my short call. That means I made $500. But we will still have to subtract what we paid to enter, which was $400. So my net profit for the spread will be $100. Overall, this is a decent strategy that I don't use all the time, but it can be really good for small portfolios because it's a really inexpensive strategy where you can make 20 or 25% per month. All right, now let's discuss early assignment in option trading. Basically, when someone exercises their right to buy or sell the underlying asset before the expiration date. So why does early assignment happen? Well, there's a few different reasons. First, there could be dividends. Option holders may exercise call options early to capture an upcoming dividend. There's also interest rates. So changes in interest rates can make early assignment also happen and could be more advantageous. However, I really wouldn't worry about interest rates because that's not something that's very common in the market. The most common is going to be intrinsic value. If an option is deep in the money, the intrinsic value may motivate early exercise. However, I'm going to show you an example how it really doesn't make much sense for someone to exercise early because the option itself is always going to be more valuable to trade than exercising it unless it's the very last day. In most cases, you do not have to worry about early exercise. But it is smart to avoid decay. Option holders might exercise to avoid further time decay on an option's value. However, again, that's going to be really rare because it's much better to close out an option and buy it back than to exercise it. You do need to be aware of dividend dates if you're going to be writing call options because for someone that doesn't have the stock, they may decide to exercise a call option so they can own stock and collect the dividend. Now, that is something to watch out for, but again, it's not going to be an issue unless you're in the last month. Then in that case, it's probably going to make sense for someone to exercise because the dividend might be more than the time value left on the option. So do pay attention to dividend dates, and if an option includes a dividend that's going to have the ex-dividend date, for example, then if you have a covered call, it might be really smart to just close it out and just be on the safe side because the worst thing that can actually happen if you do have a covered call is if you do lose your shares and you have a gain, then you will have to pay taxes, which is not that ideal because obviously depending on which state you're in, when you do sell a stock, you have a taxable event in all cases. It's just a question of, is it a loss, which is pretty good, right? If it's a loss, then you don't have to worry about taxes. It actually helps you out up to $3,000 per year, but I'm not a tax advisor. That's just from what I understand. You can write off $3,000 in losses per year and the rest gets carried over. Or if it's a short-term gain, well, you have to pay short-term taxes. Or if you hold a stock for more than 1 year, then it's going to be a long-term gain. So in most cases, you don't really want to sell the stock because if you do sell it off, then you have to pay taxes. Even if you do lose a stock, you can just rebuy it back, but it will be called something like the wash sale rule. If you have a loss, then you buy the stock back. It's not going to count. But if you have a gain, well, doesn't really matter. You're going to have to just pay some taxes and then you can rebuy the stock. That's why for me, like the best strategy when it comes to option trading is going to be covered calls and selling puts. And I do hold until expiration. I'm typically not trading options on a short-term basis. And I'm trying to create long-term, steady, passive income in my case when it comes to trading. However, you want to see for yourself what is best suited for you because there are certain strategies where you can make a lot of money, like buying call options and spreads. And those strategies are worth it because they are short-term capital gains, but they can make a lot of money. Now, I also want to talk about hedging because at this portion of the course, it's important for you to understand how to manage your portfolio in general. So we already learned the trading strategies. We learned about early assignment. Now I want to talk about hedging. So using strategies to hedge your portfolio, a hedge is basically just mitigating risk, reducing risk, or giving yourself less exposure into a really big position. So for example, let's say that you bought NVIDIA shares 2 or 3 years ago and it was 20% of your portfolio. Okay, so let's say you had $100,000, you bought $20,000 worth of NVIDIA, and now after 3 years, NVIDIA has gone up by 10x. So your $20,000 has turned into $200,000. And let's say the rest of your portfolio, the other $80,000, didn't really go anywhere. So now your portfolio is $280,000, $200,000 being NVIDIA and $80,000 being other positions. So as you can imagine, it's not that good in general to have too much of one stock because you're not properly diversified. Something that I learned in finance school when I studied finance. Basically, you want diversification. A good diversified portfolio has 10 to 15 positions. That perfect number is around 12 because in risk management terms, 12 gives you that good variability in your portfolio in terms of like having different stocks, giving you that upside, but also minimizing risk. And as you add more positions beyond 12, then your risk does go down, but you have something called diminishing returns. So diminishing returns basically is this. If you're super hungry and I offer you a cheeseburger, you are going to be very happy to eat that cheeseburger. That first one is going to be, let's assign a 10 out of 10 score. You're going to have a 10 out of 10 experience because you're very hungry, and let's say you didn't eat for one day. Now, if I offer you a second cheeseburger, you are going to probably have 9 or 8 out of 10 satisfaction. It's still going to taste really good if you're hungry, but you're not as hungry. Now, the third cheeseburger, if you're full, is going to have a very small value. It's going to have a 3 out of 10. And then a fourth one is just going to not really be something that you want at all. So it might be a 1 out of 10. So the rate at which you are enjoying the hamburger will go down because you are less hungry. And the same thing applies with diversification. So if you have one stock, you have a lot of risk here, and adding a second stock will greatly reduce risk. Adding a third stock will also greatly reduce risk, but to a little bit lesser of a degree. Okay, and so on and so forth. At 12, you can think about it as having the 2 cheeseburgers. You're satisfied, you're good. So let's go back to the example that I used with NVIDIA. So if in NVIDIA we have $200,000 worth of NVIDIA because it has grown so much, and $80,000 worth of other stocks, then what you would want to do is you want to basically take some chips off the table. You want to take chips off the table because you have quite a bit of exposure into one stock. And even if you like that stock, as an overall basket of your wealth, it's still good to diversify. So what you can do is you would sell covered calls. Now, we have talked about different deltas to sell covered calls. For me, I do like to sell 30 delta covered calls because that's the sweet spot that I realized works very well when I was working for Goldman Sachs. However, in this course, I want you to understand all the different deltas. If you go for a 10 delta, that's going to give you lots of upside and very little income because it's a low delta. There's a low chance of it happening. Therefore, it's very out of the money, and you get a small amount of money paid to you, and then a very high chance that nothing is going to really happen. And that's why there's a trade-off in finance. There's risk and return. Okay. The more you dial in the risk, right here in this case, risk will be higher delta because a higher delta means that it's in the money, and an in the money option is higher risk than an out of the money option. So if we increase the delta, and the delta is say 50, then that's going to be a high delta, and you have a high chance of losing the stock. Now, there's a risk of losing the stock. However, as a hedge in your portfolio, the reason why it's good is because you are reducing exposure into a stock that you have a lot of. And this is actually where hedging is really beneficial, because let's just say, for example, that you have the $200,000 of NVIDIA stock. If you sell 50 delta covered calls on the entire position, you can theoretically say that you have sold half of your position. The reason is because a 50 delta is a 50% chance of losing the stock, right? It's a 50% chance of being in the money. And that means that 50 delta is effectively reducing your position by 50%. So instead of having $200,000 in NVIDIA, which you will still have in theory, you are reducing your position by 50%. Now, this obviously is very volatile because options change in delta very drastically. I'm just telling you how to think about it. If you do sell 50 delta, then you're going to create income, and now you have a higher or high 50% risk of losing your shares. That could be a good thing or a bad thing, depending on if you're ready to sell the stock or not. You always want to ask yourself, am I ready to sell the stock? And if not, that's still okay, because later in this course, I'm going to show you what rolling options looks like. Now, you can also decide for yourself, this is a very smart and interesting idea, because I've seen this used at Goldman Sachs where clients have really big stock positions. You can decide to just sell covered calls at say 70 or 80 delta, which is a very high delta, for part of your position. So let's say that going to NVIDIA, you had $200,000 worth of NVIDIA. Well, let's say that you only want $100,000. Well, what you can do is, instead of selling your entire position of covered calls for 50 delta, you can sell half your position for 100 delta. That would be a little bit of an extreme case, but what you can do is you can just start selling 60 delta, 70 delta, 80 delta for part of your portfolio. Just make the math easy and simple for you to look at, and you'll understand quickly that by selling high delta options, that you're basically going to be losing part of your position, which is a good thing if you're looking to hedge. Hedging is very useful in general, but remember, the market does go up over time. So given that the market does go up over time, you don't necessarily really want to be selling high delta options. You usually want to sell out of the money options so you can collect income. And by collecting income, that's where you get consistency. So now let's move over to talking about an iron condor. We have learned what spreads are. An iron condor is a neutral option strategy involving 4 options, 2 calls and 2 puts with different strike prices, but the same expiration date. It consists of buying a lower strike put and selling a higher strike put, selling a lower strike call and buying a higher strike call. To set up an iron condor, choose strikes that encompass the expected trading range of the stock. Typically, the distance between strikes is equal. For me, that's going to be a $5 width. So before I show you an example, I'm just going to tell you that a $5 width would be basically selling a 100 strike and a 95 strike, or a 105 strike and a 110 strike. I prefer to use increments of $5. That just makes it very easy. However, if it's a low stock, let's say it's $15, then I prefer to use increments of 1. So I might sell a 14 and a 13 strike, a 16 and a 17 strike. So for me, that's the way I use iron condors, and I'm going to go over an example. But first, I do want to talk about the risk and reward. The maximum profit is the premium that you receive, while the maximum loss is the difference between the strikes minus the premium received. Here's a profit loss graph to illustrate this. Now, the break even is calculating the break even points by adding the premium to the lower short call strike and subtracting the premium from the higher short put strike. Break evens are very important because it gives you an understanding of where the stock has to be for you to be profitable. And the break even point gives you an idea of where you will also be losing money if the stock goes beyond that point. Now, the ideal market conditions for an iron condor is when the market is steady. Iron condors work best in stable or low volatility markets where the stock is expected to stay within a certain range. Also, looking at adjustments and management. If the stock moves significantly, consider rolling the position or adjusting the strikes. Always have a plan for managing your positions. However, with iron condors, since they are 4 different legs, it is typically the case that you either want to leave the position open until expiration or simply close it out for a loss. Iron condors is very difficult because since there's 4 legs, it is pretty expensive for the bid and the ask spread to really adjust them, because as you close out a iron condor and open up a new one, again, you're going to be dealing with 4 different legs. So you might lose $4 to $8 to $12, right? If the bid ask spread even has a very tight spread of just 1, 2, or 3. So there are advantages and disadvantages. The main advantage is that an iron condor gives you very limited risk and very high reward. In fact, I've made a different video on this channel discussing the tier list of option trading strategies, and I actually placed the iron condor very high. So look, the iron condor is very beneficial because you're selling both calls and puts. You can collect a very large amount of money. Let's go into my portfolio right now and let's take a look at a live trade for an iron condor, and let's go over several different examples.
I'm going to show you an example right now. I'm going to show you break-even prices, and you are going to learn exactly how to execute the iron condor. Now, this is not a low risk strategy. This is a medium risk strategy, but you can make crazy amounts of money very quickly. So let me show you what this looks like. You're going to go ahead, sell put option. This is actually going to be very interesting because it's going to look very similar to a put credit spread or a call credit spread. And that's because it's actually the combination of both of those strategies. So if you've paid attention to what a put credit spread is, if you've paid attention to what a call credit spread is, this is just the combination of those 2 strategies together. Now, what I can do is let's go to the 210. And specifically, actually, let me show you how I use technical analysis. I'm going to go to Yahoo Finance and I'm going to pull up Apple on a chart. This is going to be important because the way that you pick your break-even prices or the strike prices is crucial for being successful on the iron condor. Now, check this out. You can see that Apple has gone up a lot, so it's actually not ideal to trade right now on the iron condor. So I'm actually going to go to something else because I want you to pick a stock that is more predictable for an iron condor strategy. So I'm going to take a look at NVIDIA right now, and NVIDIA is actually perfect. I'll tell you why. So I use the Bollinger Band, which is a period of 20 days and 2 standard deviations. This is basically the blueprint for what I use to understand where a stock is trading within. You can see right now that NVIDIA is right in the middle of its Bollinger Band. That means that the stock is neither expensive nor cheap based on statistics. The Bollinger Band just uses statistics to understand volatility and price movement. All right, so right now it is in the middle, and you can see the top of the Bollinger Band is 135. Guess what? When I open up an iron condor, my top end will be 136. And you can see the bottom of the Bollinger Band is 119.51. So guess what? The bottom of my Bollinger Band, or this is going to tell me that the bottom end of my iron condor is going to be 119. So basically right now, what I'm going to do is I'm going to pick these strike prices based on the Bollinger Band. I keep it super, super simple. This is all you need. You don't need any other technical indicators. Actually, you can see right now, oh my goodness, you guys can actually see right now that I actually have an iron condor, and looks like it's working out very, very well so far. I'm up $5,620 on the iron condor, and this is actually expiring in the next couple of days. So this has been a pretty interesting strategy that I've been running in my Discord community, because I do focus on small, medium, and large portfolios. I'm coaching a variety of students. Majority are beginners, but I do have some intermediates as well. So let's start off with selling a put option. I'm going to sell a put option. Let's just say, pretty short term here. If you're watching this in the future, again, it doesn't matter. Just copy this logic, copy and paste it, and print money. Make money by copying exactly what I'm doing, right? Same logic, same thought process. Now I'm going to sell a put option. I said that the bottom is going to be around 119. Now that is actually a 20-day Bollinger Band, so I'm actually going to go out a little bit further on this options. Now let's pick the 119, all right? So I'm going to go down, pick 119, boom, and I'm going to make this a $5 width. Okay, $5 width is what I like to do. So I'm gonna, sell the 119, and then I'm going to buy the 114. All right, so this is a put credit spread. But now I'm going to open up a call credit spread, because I'm going to be selling both sides. That's what an iron condor is. Now the top of the Bollinger Band is 135.95, so I'm gonna go for 136. I'm gonna sell the 136. Now I'm going to go ahead and buy, and I'm gonna go 5 up, right? I'm gonna go $5 width, 141. So boom, now we have a short iron condor. You can see here how my maximum profit is 275 and my maximum loss is 225. So I am making literally can double my money in such a short amount of time by running this strategy over and over. As long as Nvidia stock stays within this range, which again, based on the Bollinger Band, it is likely to do so, then you are going to make money, which is fantastic, right? If the stock goes up a little bit, down a little bit, you're still going to be in this green profit zone, which is amazing, right? It's very, very important to stay within here. Now, let's talk a little bit about the break-even points. Let's talk about risk management and how much you should allocate to the strategy. So in terms of break-even points, you will see here that if Nvidia stock goes to 138.75, then basically you're going to start seeing some losses, right? On the downside, if it's 116.25. Now, why is it different? Well, it's different because you're actually collecting a lot of premium, so you actually even have more room for buffer to make money. Now, in terms of risk management, I would say that if it hits one of your legs, one of your break-even prices, then an iron condor is better to close out, because you have 2 options that you're working with. In fact, 4 option legs that you're working with. So if it goes into the money, I just simply keep it simple. I don't roll it. I don't do anything crazy. I just close out the iron condor and I move on, and I do it on a different stock. Now for allocation, this is also very important, because if you have $10,000, you don't want to put all $10,000 into an iron condor position. That's because obviously there are risks and you want to be diversified in your portfolio. You can definitely make money, but you also want to not put all your eggs in one basket. So I would say that the iron condor strategy, if you have a small portfolio, you can put in 10, 15, maybe 20% of your money in it if you're a little bit on the riskier side. And as you scale up your portfolio, this strategy should only be about 5% of your money, because it is, higher return and higher risk, and they're just more better strategies that I consider my bread and butter strategies.
All right, I'm glad that you guys now have seen an example on iron condors and how to profitably trade iron condors. Now, there's also several other factors that you do have to pay attention to. One of them is market sentiment. A lot of my students ask me, am I bullish, am I bearish on a certain stock? Well, it's really important to look at overall market sentiment, because it can help you in predicting potential market moves and making informed decisions about entering or exiting a position. The market could be very bullish and all stocks can go up even if there's no particular news. That could just be driven by human behavior, because at the end of the day, the stock market is a game that people are playing. So it's important to look and understand market sentiment if you want to make more accurate decisions. Also, there are different reports that come out into the market which are very important to look at. So one of them being a GDP report, the other being unemployment rates. Okay, looking at how people are employed in the job sector is very important for the economy overall. When the unemployment rate rises, then that is a bad sign that companies will make less money. And when unemployment rates are very low, that means that the economy is functioning very well. And when the economy is functioning very well, then people have more money to spend into the economy, and that is a sign of strength in the economy. Now, interest rates are also very interesting, because as interest rates rise, rise, they become less useful for business owners to borrow money. However, savers can make more money by depositing their funds into things like CDs. However, higher interest rates is typically a bad thing for the stock market because you want businesses to borrow money and invest that money. However, the reason why the Federal Reserve will raise interest rates is because high interest rates will combat inflation, because when interest rates are very low and everyone's borrowing money, we have seen this situation before and we see it all the time, there will be higher inflation because there's just so much money going around. So the Federal Reserve actually has a mandate. Their job is actually to keep inflation under control. And the primary tool that they use to combat inflation is going to be interest rates. Interest rates don't really rise in the short term, but they can be very different over a 5-year period. So it's important to look at, and interest rates do affect the market because it can freak out other investors. Next is inflation data. So inflation data, for example, the CPI or the Consumer Price Index, will measure a basket of goods. So that basket of goods could be coffee, gas, housing prices, a typical ticket to the movies, or basically just the basket of goods that people typically buy. Inflation data is really important when you're looking at the stock market or trading options because inflation does affect the price of stocks. It will affect the consumer sentiment. So we have recently seen some manipulation in inflation data. Just being honest with you, you have to be pretty smart when it comes to inflation, because if you look at something like education, the CPI, the basket of goods that we are looking at, can change. So I believe that the US government took out, let's say, education or oil and gas or something can be taken out to kind of manipulate the data. So I wouldn't recommend you really pay a lot of attention to, but I do recommend that you just understand basically what inflation is, because these indicators can impact market volatility and the price of stocks greatly. Also, looking at earnings reports and announcements. Earnings reports can make a really huge difference in a stock. For example, earnings can come out and a stock can move up by 20%, or it can fall down by 15 or even 30%. You see this all the time because stocks move based on expectations, and earnings is a very huge number. It gives you a good perspective on a company's financial health. So an earnings report is something that comes out on a quarterly basis. So quarterly financial results announced by publicly traded companies happen every single quarter, and those earnings events give you a very good perspective of the health of the company. Are they making more money? Are their revenues growing? Are their profits declining? Are the margin of the business improving, or is it not improving? For example, if you look at Amazon, they have like a 3% profit margin. If it went to 4%, that would make such a big difference because Amazon has hundreds of billions of dollars in revenue. So a 1% difference would add a lot of money to their bottom line. So that is something that I do pay attention to. But again, all of these different things are important to understand, but option trading doesn't have to be super complicated. You don't have to look at all of these metrics all the time. But I want you to be aware that earnings reports are very important. And me personally, I use OptionsFi as a software to track potential earnings beats, because an earnings beat will make sure that a company probably rises, and then you can make a lot of money. However, I will also say that just because I use OptionsFi software and I get an idea of if an earnings report will beat or not, it still doesn't guarantee that the stock will move in a certain direction. So you have to be careful, because a stock can beat earnings and it can still go down for other reasons. So you want to monitor earnings dates as well as your trading options. And you also want to just look at general technical analysis. Technical analysis is super important because we've been talking a lot about fundamental analysis. We've been talking about what happens in the market, sentiment. I want to quickly talk about psychological considerations when it comes to option trading. Emotional discipline is the most important thing when it comes to trading. If you finish this course, then you will understand how to trade the different strategies. And from there, it's just really important to have emotional discipline and understand how you behave when the option market or the stock market moves, because the strategies are actually pretty simple. You can just watch, take notes here, but the emotional discipline is a practice. So you want to avoid letting emotions drive your decisions to close a trade. You want to try to use as much logic as possible and intuition, because option trading is a technical game. It's something that you have to understand, but it's not necessarily a science. The stock market moves up and down randomly. There is a famous book called Random Walk Down Wall Street. You do not need to purchase the book or buy it. I'm simply telling you that the stock market moves up and down randomly. There is no huge huge winning strategy that is going to turn $10 into millions. In almost all cases, you are taking on risk and you will get reward in direct proportion to how much risk you take. Very similar to other areas of life. So if you go to school for a very long time, you make a big investment to become a doctor, you're going to have a higher salary. If you just go out there and take on a lower level job, you're going to get paid less, right? You're depending on the risk of the job. So if you're in sales, that is a riskier job, you have an opportunity to make more money. And my key rules to success is basically having several different positions in your portfolio, researching, understanding a basket of stocks that you personally really get. So for me, it's technology because I was a technology analyst when I was working on Wall Street. So for me, I do like the tech companies. I think they're growing very quickly and it actually helps me a lot with my emotional discipline. So understanding the stock that you're investing in will greatly help your emotional discipline. And emotional discipline in general helps you cut a position more properly, hold a position longer, because it's not always good to just panic and sell. And there are many cognitive biases. You want to be aware of cognitive biases when it comes to trading because you are your worst enemy in the stock market. It's not other people. It's not the stock market. It's not the news. It's actually you. So be aware of cognitive biases such as anchoring, overconfidence, and loss aversion that can affect your decision making. So overconfidence is something that a lot of people experience. It's actually something that is not good. Just to give you a quick funny story, I typically have low confidence in most things I do, despite being worth multiple millions of dollars. So is that a good or bad thing? Well, it's good and bad because having lower confidence in certain things means that I am more risk averse. I'm more scared of certain things and I'm more cautious, which has saved me in certain situations, but it also does not help in other situations. So when it comes to overconfidence, when you're super confident, let's say you make $10,000 one month, it's very dangerous, especially when you get into this game or into this investing, right? And then you do very well, you get cocky and you get greedy, and then you end up losing more money than you've made. And I've seen that situation happen over and over. So it's very important to keep a level head and avoid cognitive biases. Another one is loss aversion. Okay. Actually, ask yourself this. If I gave you $1,000 right now, how happy would you be? You would probably be pretty happy. If you now went to the store and somehow you had $1,000 in cash and you lost it, how upset would you be? Research shows that you would be a lot more upset losing money, losing $1,000 than making $1,000. So be aware of loss aversion bias when it comes to investing. And if you see a loss, it's okay to cut it. I see so many students that have lost a couple of dollars on a position. Their portfolio is up a lot, but they refuse to sell the stock until it recovers. It's not always possible to recover something. And that's true across all areas of life. I've done a lot of personal development in areas of health and relationships and in money. And it's the same across all of these areas. You can't always win. And when you do have a loss, sometimes you just have to cut it. A bad relationship, just have to let it go. Or a certain health issue, just have to manage it. It's not always possible to fix everything. And it's not always possible to recover your money in a losing option trade. So it's okay to cut your losses. In fact, I prefer to cut my losses at a certain percentage. So when it comes to, let's say, a position, I may decide to cut my losses at 5% or 10%. Or on a riskier option trade like a spread, I may decide to cut the position when it's down 50%. It does depend on your intuition, and there are no exact right answers. The market isn't an exact science, which is why I recommend that you keep a trading journal so you can learn for yourself what works, what doesn't work, what kind of bad mistakes are you making, what good decisions are you making. Using a trading journal is really good. I don't have any recommendations for a trading journal. I personally just keep track of it either manually or in a Excel sheet that I have. I'll drop a simple Excel sheet in the description. Now, let's talk about a new strategy, and that is going to be called a straddle. A straddle is an option trading strategy that involves purchasing both a call option and a put option with the same strike price and expiration date on the same underlying asset. The strategy is used when the trader expects significant price volatility in the underlying asset. So it means that you're buying calls and you're buying puts at the same time. So let's say 80 and 80. Let me show you an example of what that looks like.
Now let's go over a straddle. The ideal market outlook for a straddle is highly volatile, where significant price movements in either direction are expected. This could be due to upcoming events such as earnings reports, major news, or just regular market uncertainty. So you want to pick a very volatile stock. Let's pick Nvidia right now. Nvidia is going to be very interesting because obviously the stock has been in a very big bull run. Let me show you what a straddle would look like. So let's say that the stock has earnings. In fact, we can actually use Tesla because Tesla has had a lot of volatility recently. And yeah, Tesla has gone up a lot, but it doesn't really matter which stock you use. I'm just giving you this as an example. So look, let's say that earnings are coming up in a few days. So I'm going to do a short-term option. Now here's what a straddle would look like. I could buy, for example, the 255 call, okay? And I can also buy the 255 put. So I'm going to buy the 255 put. Now you can see that this is a straddle. If the stock doesn't do anything, you will lose money. If the stock goes up a lot, you can make a lot of money. Unlimited actually on the upside. And if it goes down, you can make money until the stock price goes down to zero. So this is a strategy that you use when you think a stock will either fall a lot on bad news or go up a lot on good news. In terms of risk management, there isn't a whole lot of risk management here. You're just basically buying an option. You are spending money and you have to be okay with spending money to make money here. So I wouldn't use a whole lot of my capital to do this, but if you're bullish or very bearish on a stock, then go ahead and use a strategy. You can use 1 to 2% of your money and basically make small bets on big moves. And this strategy can make you a lot of money. I've seen this used over and over on Wall Street, but they would primarily use this during earnings events.
Okay, now let's talk about the poor man's covered call. The poor man's covered call is an option trading strategy that replicates the profit potential of a covered call strategy, but with a reduced upfront cost. It involves buying a long-term call option and selling short-term call options against it. Here's a detailed discussion on the poor man's covered call strategy. First, the component is a long call option. Purchasing a long-term call option, or basically a LEAP, is a long-term equity anticipated security. It's just a call option. This call option is typically 1 year out. Then there's also a short call option. This is something that you use to generate income. Very similar to a covered call, but here your long call option functions the same as stock. That's why the long call option is best to be in the money, 70 or 80 delta. That way it's very similar to stock and it's very long term. It gives you the ability to sell short-term call options against the long-term call option. So there is a purpose and objective. The primary goal of the poor man's covered call strategy is to generate income through premiums received from selling short-term call options while benefiting from the price appreciation potential of the long-term call option. So in the perfect scenario, this is a bullish strategy because as the stock goes up, the long-term call option increases in value. The short-term call option, because it's out of the money, will go against you. However, if it's 10% out of the money and the stock goes up by 5%, that's perfectly okay. It's still going to be out of the money, and because it's short-term, it's going to keep expiring. As it keeps expiring, you can keep moving up in terms of selling new call options every single month, every 2 weeks, or every 6 weeks as you wish. You can sell call options on a consistent basis that acts as a covered call against your long-term call option that you bought. Compared to a traditional covered call where you would have to own their underlying asset, the poor man's covered call gives you a much smaller upfront investment because you're only buying a long-term call option. And that in many cases can be worth a tenth of buying 100 shares of stock. This strategy does benefit from many different things, which is why it's a very popular strategy and it's a very good one as well. Time decay. When it comes to selling that short-term call option, the time is going to be benefiting that short-term call option, and because it's decaying in value. However, it doesn't affect the long-term call option that you bought as much because it's long-term in the future. So you're going to be making money as time goes on if the position basically goes sideways. If it goes up, well, you're going to be benefiting from the LEAP option that you bought going up, while the short-term call option is still going to be losing value because short-term options decay in value very quickly. That's why selling options works very well, especially in the short term. What I mean is selling short-term options always usually expire out of the money, like 90% of the time they expire worthless. So it's a very profitable strategy. LEAPs typically have an expiration date over 1 year in the future. However, for me, I even go for 6 months, 8 months, 9 months, but sometimes 2 years. If I want to make a position that's very long-term in nature, 2-year LEAP option is also perfectly okay. Now the short-term call option, that's what generates income. That's what you were selling. And again, you can go for 2 to 8 weeks. That's probably the sweet spot for me. A shorter term call option has higher theta decay. Let's go over an example of a poor man's covered call.
All right, guys, now I want to talk about poor man's covered call. In my community in Henry Trades, I am placing all my trades. And specifically yesterday, I did give a little bit of a blueprint on the poor man's covered call strategy. So I'm going to read off of my Discord blueprint right here. I'm going to go into more detail. So the poor man's covered call can be used as a substitute for a regular covered call. I tell this to my students all the time because not everyone has the capital to do a regular covered call. I mean, you could need 5 figures to make a simple covered call. which is why the poor man's covered call is a very good alternative to the regular covered call. So here's the cardinal rules and philosophy that I have around the poor man's covered call. Essentially, a poor man's covered call needs to have a higher than 50 delta call option that's also longer than 6 months. If you look at textbook definition, a poor man's covered call is going to have a 70 or 80 delta and is going to go out a lot longer. But 50 delta in 6 months, that is the bare minimum. And I would say more is not necessarily better. So let me explain. You can go for an 80 delta in 12 months. That would be completely fine. But above 80, it just defeats the purpose of actually having a leap option because it's going to be very expensive. And the whole point of a poor man's covered call is that you don't want to put up all the capital that you would for a regular covered call. So that's why for me, I go for around 70 delta. All right, 70 is not necessarily better than 80. It's just in that range of 70 to 80 delta. And then from there, I sell covered calls. All right, so let's use Tesla and show you a poor man's covered call. I'm going to buy a call option that's going to expire well into the future. All right, so I'm going to buy one that's almost 1 year out for June 2025, okay? Now I'm going to buy something that has around 70 delta. You can see here, this has 78 delta, perfect. I can also go a little bit higher, the 210, this has 76 delta, so this is good. All right, so I'm gonna go ahead and buy this. You can see here how the total cost is $7,900. Well, that's a lot better than buying 100 shares of Tesla because Tesla 100 shares would be $25,000. So you're basically getting like 1/4 of the price, which is very, very good. So if I buy this call option, this is actually going to function very similar to owning stock. The reason why it's very similar is because this has a very high delta. So when the stock moves up $1, this option is going to move up by 76 cents, right? So it has a very good correlation, very similar to stock. Now, you can use this call option and sell covered calls against this call option, making it a lot cheaper. So let's just say I'm going to sell a call option here for about a couple months out. I can sell something at around a 30 delta, right? So let me go up a little bit higher. Boom, that's perfectly fine. 35 delta is good. So you can see right here how I can sell this option and make $13 on $80. So I'm actually getting a really good return. As you can see, this is a bullish strategy. You make money if the stock goes up. So this is a bullish strategy and it's basically going to benefit if the stock rises. Now I'm putting up a lot less than the 7,900. I'm putting up only 6,600 and I'm making $13 or $1,300. And I can run this strategy over and over again on a repeat.
So now I want to leave you with this. If you're interested in getting all of my trades, seeing how I trade, and having live coaching sessions with me, I do have a Discord community. This community has taught over 4,000 people how to make a consistent income. And the investors in my community have had a lot of success. And if you'd be interested in learning more about it, do click the first link in the description. Now, I also want to say that if you want to grow a small account, I suggest that you watch my small account playlist that I'm going to put up on the screen right here.